want to welcome Mr. Masling and Mr. Ryan, PTSB and Pepper. Before we begin our meeting, I wish to advise the witnesses that by virtue of Section 17(2)(I) of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter and you continue to do so, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you are asked to respect the parliamentary practice to the effect that, where possible, you should not criticise nor make charges against any persons or entity by name or in such a way as to make him or it identifiable. Members are reminded of long-standing parliamentary practice to the effect that members should not comment on, criticise or make charges against a person outside the House or an official, either by name or in such a way as to make them identifiable. I understand that we're going to have two opening statements. So, Mr. Masling.
Thank you, Chairman. Chairman and members of the committee. I am joined this afternoon by my colleague Eamon Crowley, Permanent TSB's CFO, and by Cormac Ryan and Dermot Caden, Chief Executive and Finance Director respectively of Pepper Island. In a moment, Cormac will make opening remarks on behalf of Pepper. Before he does, let me make the following points. We are here to discuss Project Glenbeigh, which we concluded on this day last week. In this regard, we recognise that NPL transactions attract considerable attention and are of real interest to this committee. As a result, as soon as we announced this deal last Thursday, myself and Cormac wrote to you, Chairman, to offer to meet with the committee to discuss this transaction. We have circulated a schematic which details the key elements of this transaction. As the committee knows, Project Glenbeigh is the second major transaction undertaken by the bank this year to reduce the ratio of non-performing loans on its balance sheet. At the start of this year, that ratio stood at approximately 26%. Together, these transactions will see the ratio fall to below 10%, a very significant improvement which will strengthen the bank by enabling it to withstand future economic shock and increase its ability to compete strongly in the years ahead. This latest transaction had been signalled by the bank for some time. When we met with this committee in October, we confirmed we were considering options for a substantial NPL loan portfolio and that we hope to conclude the transaction within months. In addition, we told the committee that we were examining various capital market options, including securitisation. And, in the end, the option we took is that of a securitisation. The securitisation option is particularly suited in this instance, as the portfolio is made up exclusively of borrowers whose loans are non-performing by reference to the guidance and definitions set down by the regulatory authorities, but who are currently meeting the terms of restructuring arrangements which have been agreed between the account holders and the bank. The customers are engaging, have a proven record of meeting the terms of restructuring agreements, and generate a steady stream of cash flow. In considering options for the portfolio, we had a number of priorities. First, we wanted to explore all the alternatives for the portfolio. These included a further loan sale and, as discussed at the bank's last appearance before the committee, to provide for and then de-recognise the loans. The loan sale option was discounted due to the characteristics of the portfolio of loans. The provide and de-recognise option was discounted due to the really high capital cost to the taxpayer and the question marks remaining as to whether de-recognition would be forthcoming. This led us to the preferred alternative of a capital markets solution. Second, We were very mindful of our responsibilities to customers whose loans are included in this transaction, so we wanted to source a capital market solution that maintained the long-term treatments they had agreed with the bank. In seeking to keep as many customers in their homes as possible through the crisis, PTSB offered the split mortgage and part capital and interest treatments widely. By comparison, to our knowledge, Bank of Ireland did not offer the split mortgage treatment at all, and PTSB offered a far greater number of split mortgages than AIB. According to published accounts, split mortgages only make up 6% of forborne loans at AIB, whereas in PTSB it is 24%. In addition, PTSB has warehoused up to 80% of the debt in some cases. This is important, since in the SSM's NPL guidance, 20% is the level above which the warehouse and main mortgage are deemed to be connected, thereby rendering it a non-performing loan. Third, we wanted to attract credible investors who will hold the notes issued by the securitisation vehicle for the long term. We have achieved that by focusing the transaction on loans which are adhering to the terms of restructuring agreements and producing consistent, predictable cash flow. This makes the securitisation vehicle an attractive proposition for long-term investors. Fourth, we wanted to ensure that the restructuring agreements, which had been agreed and overseen by Permanent TSB, would be respected under the securitisation alternative. We have achieved that by ensuring the agreed restructuring arrangements form part of the terms and conditions of the individual loans, which are included in the transaction. Fifth, the bank was advised that it would not be granted NPL derecognition status for these loans if it maintained the servicing relationship. Therefore, we wanted to ensure that the company appointed to service and administer the loans going forward will be credible and respected. We have achieved that with the appointment of Pepper Ireland. I will let Cormac detail Pepper's credentials himself, but we were attracted, in particular, by the fact that Pepper is regulated and authorised by the Central Bank of Ireland under the Central Bank Act 1997 as a retail credit firm for the provision of credit and credit servicing activities in Ireland. The company has been in Ireland since 2012, employs over 380 people in both Shannon and Dublin, and, including the accounts included in this transaction, manages some €10 billion of Irish residential mortgage loans. In short, Pepper is a well-established and important part of the financial services infrastructure in Ireland. Sixth, we wanted to ensure that the bank's customers understood what was happening with their loans and the implications the securitisation might have. We have achieved this by writing to all the relevant account holders, outlining answers to common questions, providing additional information online, and encouraging customers to contact our support staff to discuss any issues which they may have. Seventh, we wanted to ensure that scheduled reviews of any restructuring arrangements treated customers fairly. Again, Cormac can outline how Pepper will approach this process, but I would make the following points. Under the Master Servicing Agreement, or MSA, Pepper, as the Master Servicer, has the full power, authority and right to undertake all activities that it reasonably considers necessary, convenient or incidental to the provision of the services under the MSA. The securitisation vehicle itself has effectively legally delegated these decision-making rights to the Master Servicer as the Irish regulated entity. A review mechanism is commonplace in all restructuring arrangements. If the loan had remained with Permanent TSB, the bank would undertake reviews with the same objectives Pepper will have in the future. If the circumstances of the borrower have not changed, there is a legal obligation to continue to comply with the terms of an existing restructuring arrangement. This is an important overlay as the bank set out to maximise customer protection. If the circumstances of a borrower have changed, either positively or negatively, then, as would be the case with Permanent TSB, the arrangements may be reviewed to reflect the changed circumstances of the borrower. In this regard, it is worth bearing in mind that the restructuring arrangements in place all involve the agreed suspension of repayments on a significant amount of the money borrowed by the customer. Those warehoused or bullet amounts remain due at the maturity of the mortgage term. Therefore, it is important the arrangement is reviewed regularly to see how that amount might be reduced over time to the benefit of the borrower. Of course, post this year's transactions, the bank has further work to do to lower its NPL ratio. That said, we will continue to build on the work already done by the bank in moving customers from non-performing to performing status, with a focus on, amongst a number of initiatives, natural cures and mortgage to rent. Finally, to conclude, this transaction is very significant for the bank, and given the challenge we face to tackle NPLs, I believe it is as good a solution for customers as we could deliver. It has much to commend it. It allows Permanent TSB to reduce significantly its NPL ratio. It creates a vehicle which attracts long-term, stable investors. It locks in the restructuring agreements already agreed between the borrowers and Permanent TSB. It brings on board a highly reputable and regulated servicer in Pepper. So, Chairman Committee, that concludes my remarks, and now I hand over to Cormac Ryan of Pepper Island. Thank you,
Mr. Masding. Mr. Ryan.
Thank you, Chairman. Good afternoon, Chairman and members of the committee. Firstly, thank you for your invitation, and I'm pleased to be here today. My name is Cormac Ryan, and I'm here in my capacity as CEO of Pepper Finance Corporation Ireland. I have held this role since I joined the company in October 2017, and I'm accompanied here today by Dermot Caden, on my left, Finance Director, who will assist me in answering your questions. I would like to thank you again for the invitation to attend this session to discuss the securitisation transaction, Project Glenbeigh, announced by the PTSB on Thursday, November 29th. I'm pleased to have an opportunity to give you an introduction to Pepper and to outline our planned approach to managing the 6,000 plus borrower relationships on behalf of Glenbeigh Securities once the customers transfer to Pepper from PTSB in the next 6 months. I would like today to provide the members of the committee with as much information, insight and reassurance as possible when it comes to this transaction and our management of these customer relationships into the future. I would like to take this opportunity to give you a brief background on Pepper and our strong track record in Ireland. The Pepper Group is an international financial services business specialising in loan servicing, lending and advisory services. In Ireland, our main business is loan servicing. We entered the Irish market in 2012. With our original 100 employees from the outset, we sought to position Pepper as a leading loan servicing firm, providing a new and important service to banks and investors in Ireland by leveraging our significant track record and experience globally in onboarding and managing loan portfolios. In particular, we are specialists in helping people experiencing financial difficulties manage their situation and get back on track through a sustainable solution suited to their individual circumstances. When we entered the market in 2012, viable solutions for customers were in short supply. We have focused on delivering a wide range of new strategies and initiatives to assist customers in the Irish market. This has, for example, included split mortgages and mortgage to rent. Pepper has completed more mortgage to rent arrangements than any other firm in the Irish market. Pepper is a regulated financial services provider, regulated and authorised by the Central Bank of Ireland under the Central Bank Act 1997 as a retail credit firm. Pepper is authorised to provide credit in Ireland and is deemed a credit servicing firm, authorised to provide credit servicing under the 1997 Act. Pepper Ireland currently services over 64,000 loans in Ireland across all asset classes, which were valued at circa €16 billion at the end of 2017. Following the Glenbeigh transaction, we expect to be servicing approximately 10 billion of residential mortgage loans for customers, with over 80%, 4 out of 5 mortgage loans of those fully performing. We employ approximately 380 people in Ireland. The majority of our employees operate from our Shannon office in County Clare, and we also have an office in Dublin. Our customer-facing teams are made up of highly experienced people with specialised expertise operating in full compliance with regulatory codes. This is one of the reasons why banks, investment funds and long-term investors such as PTSB and Glenbeigh Securities entrust their customer relationships to Pepper. The growing number of long-term performing and re-performing loans under our management is consistent with our long-term commitment to Ireland. Our strategy and plan is to continue growing and developing our business here and become an ever more important part of the financial service fabric in Ireland. Our commitment to the ongoing growth of the business forms part of a wider European strategy to grow our loan servicing business across Europe. Ultimately, our long-term growth ambition for the Irish business is to export our services into the European loan servicing market as that market develops. Let me talk about our approach to customers. Our team mission at Pepper is to help people succeed. Finding solutions for customers is part of the Pepper DNA. Like many financial services companies, we are not perfect, but we are working hard every day to improve how we service customers and find solutions for them. From a personal perspective, I have looked to reinforce this focus on customers in Pepper Ireland by treating customers fairly and achieving a positive customer experience being set as one of the 5 key strategic priorities in the Irish business. In 2018, we set up a dedicated customer experience programme to improve the skills of our customer-facing staff working with customers in all situations, day in, day out. This includes quality assurance and complaint handling to ensure ongoing review and continuous improvement. Every single member of our staff, regardless of level, regardless of team, has treating customers fairly built into their performance objectives. We're proud of our people and their strong track record in managing loan books and servicing customers. We recognise every customer situation is unique and each case needs to be treated on its own merits. For customers in arrears, we use our experience and range of alternative repayment arrangement solutions to work with these customers constructively and sympathetically to, where possible, put in place sustainable solutions that are tailored to their individual circumstances and their individual situations. Having the benefit of that background to Pepper our expertise and approach to customers, let me turn to the Glenbeigh portfolio and how we plan to engage with these customers. I appreciate this is a matter of significant interest to the members of the committee and to the customers included in the Glenbeigh portfolio. I would like to repeat and expand on the assurances that I have previously provided to the PTSB board and to the CBI leading up to this transaction, and provide 5 key assurances from Pepper to customers in the Glenbeigh portfolio. Number 1, all the customers transferring to Pepper in the next 6 months as part of Glenbeigh will be fully covered by the protections of the Central Bank's Consumer Protection Codes and regulations as they were before, CPC, CCMA, SME codes as applicable. Number 2, Pepper is legally obliged to adhere to, and we will honour, the existing terms of any previously agreed restructure if the customer is meeting all the terms of their restructuring arrangement. Number 3, if the borrower's personal circumstances do not change and the customer engages in a review process, there is a legal obligation upon us to continue to comply with the terms of the existing restructuring arrangements, and we will do so. Number 4, following a change in the borrower's circumstances, any change to the restructure will reflect the relevant improvements or disimprovements in the borrower's circumstances. And finally, number 5, where a borrower's circumstances have disimproved or disimproved in the future, we will work with that customer to constructively find, where possible, a long-term sustainable solution to their individual situation that is in their best interests as is laid down in the codes. Every case is different, and we are known for taking an individual and personal approach to working with customers based on a deep understanding of the circumstances. Being a regulated entity in Ireland, Pepper takes its responsibilities and its reputation in Ireland extremely seriously. We apply the highest standards of corporate governance across our business, and we work extremely hard to ensure we comply with our regulatory obligations and meet our legal and contractual commitments. In looking at how we plan to engage with customers in the Glenbeigh portfolio, I would note that this portfolio is made up of customers who are currently meeting the terms of their restructuring arrangements, which have previously been agreed between the customers and PTSB. The customers have been engaging, they have a proven track record of meeting the terms of their restructuring arrangements. The relevant accounts, as Jeremy has noted, generate a steady stream of cash flows, and these are attractive to long-term investors, and Glenbeigh the securitisation vehicle is presenting itself as a long-term investment vehicle. Taking this into account, and in addition to the 5 assurances I have provided above, I will make the following final points on how Pepper plans to manage the portfolio to treat customers fairly, especially during the process of scheduled reviews of any restructuring arrangement. Some of these points will echo what Jeremy has already said. As Master Servicer, Pepper has the full power, authority and right to do all things that it reasonably considers necessary within applicable laws and regulations to manage the portfolio. The Glenbeigh vehicle itself has effectively legal delegated these decision-making rights to Pepper as the Irish regulated entity. A review mechanism is commonplace in all restructuring arrangements, as it is in the Glenbeigh portfolio. If these loans had remained with PTSB, PTSB would have reviewed with the same objectives as Pepper will have in the future. Over 80% of the restructuring arrangements in place, and I would note 50% are over 20 years, have an average of 10 plus years to run, and all involve the agreed suspension of repayments on a significant amount of money borrowed by the customer. These warehoused amounts remain due at the maturity of the mortgage term. It is important and in the customer's best interest that the arrangement is reviewed regularly with Pepper as a master servicer in the future to see how that amount may be reduced over time to the long-term benefit of the borrower. In closing, I am here to assure customers transferring to Pepper of our positive track record in standing as a regulated entity in Ireland and set out again the 5 assurances I have provided above. It is our hope over the long term that customers transferring to us will come to view their engagement with us as a positive experience and that we have treated them in a fair and transparent way. I'd like to thank again the Chairman and the Committee for their invitation and will be happy to answer your questions on the Glenbeigh transaction.
Thanks very much, Mr. Ryan. In view of the fact that this is your first visit to the committee, can I take it that, having heard all of what you've had to say, that you'll come back to us on a regular basis?
It is indeed, Chairman, my first invitation to the committee. I'm very pleased to be here today to talk about the Glenbeigh securitisation. I'm absolutely open to future invitations, and I will carefully consider any future invitation that I receive.
Is that a yes or a no?
I'll carefully consider any invitation I receive.
Deputy Burton.
Thank you. And first of all, I want to thank the witnesses from the PTSB and from Pepper for coming and attending the meeting today. It's been a great source of frustration for members of the Oireachtas that really there's been little or no accountability in respect of, in inverted commas, investment funds and how they treat mortgage owners. And I think this is a key question in terms of the transfer which the PTSB is undertaking. So I want to start with the case of a constituent that I've been dealing with for quite a number of years in respect of her PTSB mortgage. And I have to say, I have been on to the PTSB numerous times over the years about this mortgage. It's a rather sad case. It's a family with 3 children. One of the children has a severe disability in relation to autism, dyspraxia and severe anxiety disorder. And while both parents work in the public service, one of them has been subject to severe health issues from the stress of the mortgage, and there is a restructured loan agreement currently in place. She's adhered to all of the elements of the agreement, and in fact on a couple of occasions has exceeded it in order to try and clear it if possible. Now, the PTSB has miscalculated her arrears. She has been with Walia and MABS who've given her advice around the miscalculations, but she's never been able to get satisfaction on that. And most appallingly of all, and it was the point at which I became involved as a minister, was that at the time the PTSB sought to include the child's domiciliary care allowance in the calculation of the payments that the family would make. Now, in fact, I as Minister, got the banks generally to stand back from that kind of draconian action towards families with disabled children. It was a particular low point. So yesterday, or the day before, the family received a letter, like a lot of the other 6,000 families, from Pepper advising them that they were purchasing her loan from the PTSB. Clearly, they are in enormous distress. Their son with the disability is now 13, and he is obviously constantly suffering from anxiety, so this has an impact within the family. And she, quite frankly, is scared as to how Pepper is going to handle this. You know, you've made a very succinct presentation here, but actually there's a lot of questions about the management that lie under this presentation. So I think we all have concerns about how split mortgages are going to be dealt with by investment funds, because while I can understand you're a financial corporation, essentially this is orientated towards an investment fund model, notwithstanding indications that were previously given by the Minister for Finance on this. I have the family's consent to speak with you, with Pepper, about the split mortgage. So I want to ask the witnesses from Pepper is that when you bought the PTSB split mortgages, was the total amount of the warehouse sections of the loans discounted from the price of the loan sold to them? We have some summary figures, but it's not very clear how the warehoused elements of the split mortgages were valued and where they discounted. And either or both of you might be in a position to answer that. That really is a key question. In respect of the warehouse sections of mortgages, are Pepper seeking to write these off, or are you seeking to recover them in full? From your presentation, I'm kind of assuming you're actually going to seek to recover them in full, and that you're not, in fact, going to write them off, even though you may have got those sections of the loans at a heavily discounted value, maybe 100% discounted, I don't know. This particular family, like a lot of the families, as you said, these are all loans where people have reached agreement and where, in fact, and I think other members of the committee, we have correspondence from other people, they're meeting their terms and conditions, and now the mortgages are being sold over their head. And the key question is, when do you propose, and how often do you propose to review the mortgages, and will that then include reverting to the split loan, to the warehoused element, and charging in full for that? I think we really need to know how you're going to treat this, because this is what is going to keep an awful lot of people awake at night. You talked about a relatively short period in terms of 10 years, in terms of workouts and so on. I think you could tell us a little bit more about that. And what I also want to ask you as well, the investors who are benefiting from the securitisation income stream, and I think we have a note suggesting that the portfolio is generating cash, which is the equivalent of more than 3% of the asset security. So will the investor benefiting from the securitisation income stream, will they have any role in the management of the loan portfolio, or is that entirely up to yourselves? And I suppose what we should ask PTSB, is this a final sale from PTS point of view once the 6 month is concluded and thereafter they've washed their hands, or do you remain in some way investors in the investment fund and therefore potential beneficiaries from the securitisation stream of income as it arises?
Good afternoon. Deputy. I think there were 3 questions which related directly to PTSB. One, the nature of the deal, 2, the customer that you mentioned and the sad circumstances therein, and then thirdly, PTSB's continued involvement in the securitisation. So, Cormac, if I take those 3 and then you can summarise the other questions, is that okay? Eamon, perhaps you might just want to give a high-level view of the deal and how split mortgages are placed in that deal, please.
So I'll actually answer the first and third question that Jeremy referred to. So the first question relates to the price that was paid. The nominal value of the loans included in the portfolio are 1.3 billion. The price paid is in the region of 900 million, so that represents the discount on the portfolio. The portfolio is primarily made up of 2 types of arrangements, long-term arrangements, split exposures and part capital and interest exposures. There isn't a separate price for either. It was one price for the whole portfolio. It's a bundle, yes, from that perspective. And naturally, there's over 6,000 different customer relationships there, which have different perspectives around the level of bullet repayment, the interest rate attaching, whether they're on variable rates or on tracker rates. So there's a very mixed bag within that. But there are 2 types of arrangements, and the reference to the warehouse would not be attainable. But the key thing is that the nominal value was 1.3 billion, and the price being paid was in the region of 900 million. With regard to PTSB's ongoing involvement, the transaction closed on Thursday. Within 6 months, the full servicing of the portfolio will switch to Pepper. So in the first 6 months, PTSB will continue to deal with customer calls, deal with customer interaction. We will do that as sub-servicer, so Pepper are the master servicer in that regard, but we will sub-service for the first 6 months. And legal title to the mortgages will actually transfer at that period as well. So for the purposes of the interaction with the customer in relation to these mortgage exposures, our interaction will cease at that moment, and Pepper will become the absolute prime party for communication for the customer. With these customers, we have other relationships. They have current accounts and things of that nature with us, other products, so that relationship will continue. But with regard to the interaction with regard to these mortgages, that will cease. The second part of that question relates to our interest in the portfolio. We retain a 5% interest in the securitisation vehicle. That interest is across all the different notes within the, so it's what's called a vertical slice, a V note. This is a legal requirement that came into play post the crisis, where an originator of portfolio had to retain some interest in that portfolio, and we are following regulations in that regard. So we will continue to hold 5% of the portfolio. So they're the 2 key. And
what's your anticipated return on that holding?
We don't know. We don't have an anticipated return. We are required on an annual basis for accounting purpose to value that interest. At this moment, the valuation is based on the price that we received last Thursday, and we will judge that at every year end. But it's not. We've no view on it going up or down. It is a requirement that we hold that 5%.
And in terms of the transfer, in terms of the warehoused elements, how did you? I appreciate it's a bundle. But how did you approach the valuation of those? Did you value them, as it were, in full, or did you discount them in terms of transferring them?
We wouldn't. No. The legal title to the mortgage was the amount due on the mortgage is still due. It's 1.3 billion. It's the full amount. 1.3 billion is the nominal amount. we have actually sold the portfolio at net book value. So it equates to the value of the loan less the provisions that the bank would put against that portfolio. It isn't a valuation per se, it's the amount of provisions that the bank had put against it based on accounting rules. But it isn't a valuation per se. But it was a reference point to us with regard to the price we received, and that's all.
So, in other words, what you're saying is, having sold it to Pepper, from your point of view, essentially people own the full amount, and notwithstanding whatever discount arrangements arose in the terms between yourselves and Pepper, it is unlikely, or is it likely, that customers would get any deals in relation to the restructured amounts that are hanging over them?
Well, that's a question for Pepper. But indeed, within our interactions with customers, some have improved, i.e. they've improved by way of reducing the level of warehouse, and some have stayed the same. And indeed, customers that did not meet the terms of existing arrangements were not in this portfolio. In fact, they were in gloss. Some of them were in the gloss portfolio, which is the previous portfolio. So these are customers who are meeting the terms of the arrangements that have been set forth, and are engaging with the bank with regard to where they are with regard to thinking about the bullet repayment or the outstanding amount that they have to service in due course. And as I mentioned, some improve as regards that in interaction, and some stay the same.
I had a second question,
yeah.
Deputy. I think you had three questions. I obviously can't discuss individual customer circumstances, but as per previous appearances, myself and a colleague will talk to you after the committee, and we'll try and get to the bottom of the individual case for you.
Okay, thank you. So, would you like to tell us then about how you're approaching?
Just have to answer because your time is expired. Mr. Ryan, are you finished?
Yep. Thank you, Deputy. Firstly, thank you for raising the important matter with this customer. It sounds like quite a distressing case. Like PTSB, I would like to get the details afterwards to ensure when this customer comes across to the management of Pepper, we ensure that the customer is flagged as a vulnerable customer and follows our specific policies that we will have for customers in those types of situations. Before I move on, I just wanted to clarify, I guess, exactly what our role is and isn't in the transaction. The sale of the Glenbeigh portfolio has effectively been a sale from PTSB and a purchase by Glenbeigh Securities, which is the securitization transaction. And effectively, the ownership is now split. The beneficial ownership of the loans, so who actually owns the economic interest, sits with Glenbeigh, and the legal title holder sits with Pepper. We effectively have two roles. One, we have legal title holder, which means we are the lender of record. And secondly, we have been appointed as the servicer to effectively manage and administrate the loans on a day-to-day basis. When it comes to who bought the loans, we didn't actually buy the loans. Glenbeigh Securities bought the loans and then passed legal title to us, and then has appointed us as the servicer on the portfolio.
And the other questions?
The other questions to pick up was how will the warehouse debt be treated? So in terms of your summary is correct. The warehouse debt is part of the transaction. Glenbeigh Securities are taking on those loans in terms of the economic ownership. That will move across in terms of the 1.3 billion, and that will ultimately be owned by the bondholders at the back. What I would like to clarify is within the prospectus, there is a part of the prospectus which talks about eligible debt forgiveness. So there is a mechanism, and I want to be very careful in what I say, so I calibrate my comments correctly. There will be a mechanism in very exceptional cases, in certain cases like vulnerable customers, and in other cases where there are insolvencies, that when we do reviews, and it will depend on each of the individual circumstances, there is a mechanism in place for there. But the main answer to your question in terms of what happens to the warehouse debt moves across. As I said at the beginning, over 80%, actually 86% of the loans mature in plus 10 years, and actually over 50% don't mature till 20 years. As the loans currently stand, there is a bullet payment due at the end. and that's the way the loans have been transferred across. Your third and final point is your second question was who's actually going to do the reviews and how are they going to be carried out. Per my opening statement, the arrangements, if there is no change, absolutely stay in place. No different to PTSB, it's appropriate and in many cases in the best interest of the customer to have regular reviews. The current protocol within PTSB is that these have been done up to triannually. That doesn't mean every 3 years, it means sometimes it's every 3 years. We will look at the frequency of that. I can say there is absolutely no plan to conduct reviews at an inappropriate frequency. Some reviews will continue on a 3-year basis, some may move to 2 years, some may move to 1 year. But again, I can give an additional assurance today that there is absolutely no plan, unless the borrower comes to us, to review any arrangement more than once a year. I would also say that the reviews and how they're carried out and how it's notified to the borrower are strictly governed and controlled by the CCMA. The reviews must be at appropriate intervals. We must give a month's notice, and we will absolutely abide by that in terms of carrying out the reviews. And I would also add that when we do the reviews, per my opening statement and per the code, we will carry those out constructively and sympathetically. If nothing has changed, if everything is in the exact same way, the arrangement stays in place and we move on and schedule the next review. To your last question on control, again, explaining the structure, PTSB have sold, Glenbeigh Securities own the loans in terms of the economic interest. We are the legal title holder and the servicer. The way this transaction has been set up, and per my opening statement, we have been put in full control to manage and administer the portfolio on a day-to-day basis, and effectively Glenbeigh have delegated that legal authority to us.
Deputy McGrath.
Yeah, thank you very much, Chair. I'd like to welcome our witnesses today. Mr. Masling, over the last 24 hours, as these letters have landed in the letter boxes, we have all been contacted by a number of the affected customers. They don't have the opportunity that we have, but I think it's important to convey to you that certainly some of them feel very betrayed, they feel very angry, and they are worried. And they have those feelings because they cooperated with Permanent TSB. These are good customers who engaged and who faced up to the challenges that they had financially, and who entered into a restructuring agreement and who are honouring that agreement in full. So I think they had an expectation that your bank would stay the course with them, and that these loans were essentially good loans, or loans that were well on the way to being cured. And I think it's important to convey that to you, because we are receiving a lot of emails, a lot of contact. It's important that people receive the reassurance that they are being given, and that's really at the substance and the core of what this session should be about, to try and tease out exactly what this means for customers. And if I can maybe just come back to you, Mr. Ryan, on the question there from Deputy Burton. So Pepper will have the legal title of the loans, and responsibility for making the decisions has been assigned to Pepper by Glenbeigh Securities.
Yes.
So are you saying categorically that the actual decisions around the governance of this portfolio, the decisions around individual loans, will be made by Pepper and by nobody else?
Yeah, so the prospectus is quite clear on this point. There will be a committee, the prospectus refers to a committee. Again, it's quite clear that we will consult the committee, and that on the committee the bondholders can be represented. But it's also...
what's this committee?
This will be just the operating committee that will meet once a month in terms of reviewing matters around the portfolio itself.
And who's on that committee, sorry?
Effectively, the master servicer and a representative of the bondholders, the main beneficial owner.
The master servicer being Pepper?
Master servicer being Pepper.
Yeah. And who else is on the committee?
The main beneficial holder, so the main investor.
The main investor?
Yes.
Okay. And what will be on the agenda of that committee? What decisions will it be making?
That will really be in terms of decisions made on the portfolio, in terms of reporting back on where we are on rearrangements. Those decisions will sit squarely with Pepper. So if we find we want to change, if we do a review, and let's say somebody's circumstances have disimproved, we need to help that customer, we will, for information, report that back to the customer. That will sit with Pepper. Another important role And another important delegated authority is setting interest rates, so that the interest rate setting will sit with Pepper. And again, we will just, that will be discussed. We will hear representations. But the prospectus is very clear. That is in a consultative capacity only. The decision-making remains with Pepper.
Okay, so I mean that really is the nub of it, the influence that the investor will have. So the investor will be sitting on this committee, which meets monthly. Pepper will be on the committee. You're saying its role is consultative.
Yes, and that's quite
clear. But I mean, it will have full access to information about the performance of the portfolio. Presumably will be reviewing the performance on an ongoing basis. And I mean, the question is, can it then influence Pepper's management of the portfolio? If it wants a higher income stream, if it wants Pepper to be more aggressive, like, does it have that influence? I'm just not entirely clear about precisely who's making the decisions, and are those decisions being made free of any undue influence by the investor?
So to answer your question, Deputy, the first point is, in the prospectus it is quite clear. The material control, and as I said in my opening statement, has been delegated to Pepper to make strategic decisions and control decisions on the portfolio. It is not unusual in a situation like this, where Pepper has no economic interest in the portfolio, for the economic interest or the beneficial owner to be represented on that committee. The second point is, you mentioned in terms of influence and aggression and everything else. Our main role, remember, is a servicer in this portfolio. We are regulated in Ireland. Every single interaction we have with a customer is governed by the CCMA code and the CPC code. We need to act in the best interests of the customers at all time. So when we're doing reviews, we absolutely will have that at the forefront of our mind. They have delegated to us. They'll be aware of certain things that we do, but ultimately things will sit with Pepper. I would also like to bring up one other point to make sure there's absolute clarity on the concept of eligible debt forgiveness. When it comes to, and I'm aware that we may have Glenbeigh customers listening in today or listening to the transcript, so I want to calibrate my words very carefully. So I'm absolutely answering your questions, but I'm also helping customers understand how this will operate, but equally not setting on any unrealistic expectations. If there is any situation where we think, which is absolutely exceptional, looking at an individual circumstances, where there is a case that the right thing to do is to enter into a debt forgiveness, that is something, and there is a detail in there, that we need to agree with the bondholders, because ultimately they need to be happy with that. But that is the only exception to the decision-making power of Pepper in Glenbeigh in 6 months' time when they take on the portfolio.
Okay, is the prospectus a published document, or is that a confidential document?
It's a published
document. That's a published document, okay. Who are Glenbeigh Securities?
So Glenbeigh Securities is a securitization vehicle. It has investors behind it. I know the committee would like me to comment in terms of who the investor is. Our own personal view, and the view of Pepper, is we would like maximum transparency in all these cases. We've actually worked hard in the background, both in this case and in other cases with investors and with clients that we work with, advocating that transparency is the best approach to these transactions. In this case, I am not in a position to confirm who the lead investor is on Glenbeigh Securities.
And will their identity remain private and confidential indefinitely?
It's difficult for me to speculate on what will happen long term. I'm subject, both personally and my firm are subject to a non-disclosure agreement. There are legal consequences for me if I make any disclosure or speculate in any way as to who the bond investor is.
Is Pepper required under the agreement with the investor to deliver a certain level of cash flow, a certain income stream from the securitisation?
No.
No. And can the investor seek a greater return, seek a higher income stream from the portfolio?
There is no set formal mechanism for them to require us to hit any target.
Okay.
Our role in the portfolio, just to clarify again, is to hold legal title on the portfolio, to make day-to-day decisions on the portfolio, and to effectively, you have a performing portfolio. 98% of these arrangements are performing. The prospectus is quite clear in terms of the cash flow. We collect the cash and return that to the owner.
But just to be absolutely clear, like, are you giving a reassurance that that Pepper will be making all of the decisions about individual loans, and that will be done without any influence by the investor?
I wouldn't characterise it as such. And again, it's clear, all authority to make day-to-day decisions on the portfolio are delegated to us. I do need to abide by the prospectus, which requires us to hold a committee and consult with the investor in terms of how we're running the portfolio. I wouldn't characterise that as influence, but we will be consulting with them as we run the portfolio. Again, it's quite clear in the prospectus, we do not need to follow the direction of the investor.
Okay, but I mean the concern here, and the concern I would have, is that in reality, in practice, when this arrangement is up and running, that the investor will be pulling the strings, calling the shots, in effect, behind the scenes.
Yeah, number one, in terms of the mechanics of the prospectus and in terms of the mechanics of the master servicing arrangement, that is not the case. It's set up in a way to very clearly delineate the responsibilities and assure people who read it that Pepper are in charge. The second thing I'd say is this all comes down to back to the customers and back to their arrangements, and it comes back to the point in terms of what is the return and cash flow from the actual portfolio itself. Two key points. One, we're governed by the codes, and two, all of the protections, all of the contractual obligations that we have around these restructuring arrangements stay in place. It doesn't really matter what we decide to do in the portfolio. Those arrangements stay in place. The only way any of those 4,000 splits will change is if circumstances change.
Okay, but just to be clear and to be fair, the terms of the split mortgage agreements entered into by permanent TSB with customers, which I have read, give an exit clause to the loan owner at any point. You don't have to wait for the review. What it actually says is, for any reason that the bank, or now Pepper, thinks fit, it can terminate the split mortgage. It doesn't even have to wait for a review. Like, that's what it actually says, split mortgage agreements.
That's, again, I'll go back to the assurances I gave. That is not our interpretation of the agreements.
So you're giving a reassurance that you will not terminate split mortgage agreements unilaterally?
What we will do is we will do the reviews when we decide it's the right time with the customers to do the reviews. As I said in the assurances I've provided for you today, to the PTSB board and to the CBI, under CCMA codes, those arrangements, unless there is a material change in the circumstances of the borrower, we, both legally and from a regulatory point of view, cannot change those arrangements.
Does Pepper offer the full suite of forbearance measures set out in the Code of Conduct on mortgage arrears? Are there any you don't offer?
No, we offer pretty much the full set.
So the arrears capitalisation, term extension,
exactly, and we
split
run
mortgages.
Yes,
you do the full suite.
So we did a review in terms of what we offer versus what PTSB offer. As you know, the code doesn't set out exactly what you need to offer, but just that it expects you to have a full suite. Our suite is full. It's comparable to PTSB and it's comparable to all the lenders.
Okay, final question, Chair. Mr. Masling, to be fair to you, I didn't give you a chance to respond to what I said at the beginning, and if you wish to respond and just confirm if the Minister for Finance, as the principal shareholder, has been formally consulted as provided for under the relationship framework. If you can confirm when that happened, when was there contact with the Department of Finance, and what the response of the Minister was.
Thank you, Deputy. I think you made 2 points. First, in terms of your general comments, of course, I would understand the feelings of the customers that you mentioned. In this particular case, as we've discussed in my previous appearances, post-gloss, PTSB's NPL ratio is 16%, and the European average, actually, since we last met, has been recalibrated at 3.5. And so it is important both for our ability to withstand future economic shocks and our ability to compete in the retail and SME market that we manage down the NPL ratio. In terms of this transaction, as I mentioned in my opening remarks, the bank believes that this is the right outcome for customers in terms of them maintaining their treatments. It is the right outcome for the bank in terms of reducing its NPL ratio, and we think it's the right outcome for sort of Island PLC because it enables PTSB to continue to compete. In terms of your second, in terms of your second question, if you just rephrase it for me in terms of the specifics, then I can answer it.
Just the consultation with the Minister for Finance under the
So
relationship framework to confirm if it happened, when it happened, when was the Minister first informed of this transaction, and then what was the response received by the Minister?
We consulted with the Minister in accordance with our responsibilities under the relationship framework, and the Minister replied at the end of November with a letter of non-objection, which was the requirement of the PTSB board.
Thank you.
Thank you very much. Senator O'Donnell.
Thanks very much, Chairman. Welcome, Mr. Masding, Mr. Ryan, dear colleagues. Can I just talk about Glenbeigh and the structure of Glenbeigh under prospectus? Is it an Irish registered entity? Who are the shareholders? How does the board work? Under prospectus, what type of rate of return was it offering to potential investors? Why is Permanent TSB retained a 5% rate would say, investment in it? I'm trying to figure out why it was set up and how it works. And in the event, we'll say that Glenbeigh was wound up, who's the beneficial owner of the loans? You're saying they're in Pepper. Do Pepper have currently, did they purchase loans, previous batch of loans from Permanent TSB? Are they managing any existing portfolio? I just want to get a feeling around Glenbeigh. Why? How does it differ from an outright sale directly to a fund, both in terms of structure and obviously how you deal differently with the end consumers, which is our main concern. But I want to know about Glenbeigh.
So, Senator, I'll answer some of those questions, and Cormac can answer some of the ones related to Pepper. So, the origination of Glenbeigh is actually by Permanent TSB. So we've actually originated the structure. Why? Well, what we were trying to do was match the long-term interests of customers, where they are involved in long-term arrangements, with longer-term investors, and in a way manage and control that relationship by way of a vehicle, a securitization vehicle.
And the bond, and I want you to keep going, the bonds that you, under the perspective, what's the term of those bonds?
Okay, the term of the vehicle itself is out to 2057. That is, if you look at the prospectus, that is the final date of the securitization. Indeed, it could run to that 2057.
So if you look at the makeup of the securitization and the bonds, are they of varying lengths and duration, or are they all of a similar duration?
The bonds are, there's different bonds because each of them have a different risk profile, which would be typical for a securitization vehicle. They have a maturity date which is the same.
I need you to explain to me, to help me to understand how you've structured it so that the funding that's been provided to the vehicle is long-term in nature, that we don't have a situation whereby Glenbeigh bondholders turn around and say, we want our money back tomorrow, and suddenly the whole issue of setting up something as a long-term vehicle, to be honest with you, it doesn't hold water. So I need you to help me to understand how the structure of Glenbeigh is long-term. Okay, and I'm going back to the bonds.
Okay, so the
minimum duration of the bond and the maximum duration of a bond.
Well, the maximum duration is effectively 2057. But over that time, customers would continue to pay down their loans, and the notes would continue to pay down.
I'm happy enough. I'm dealing purely with the money provided to Glenbeigh.
Okay,
so 2057 is what? That's about 30 years away. What's the minimum duration of a bond?
The minimum duration
of the bonds under the perspective?
At this moment, the minimum is 6 years.
And so if you break up, how much in total is Glenbeigh raising by way of bonds?
It's raising in the region of 900 million.
900 million?
Yes.
And if you make up the breakdown of that, how much of that is, we'll say, how much, so of the 6-year bonds, give me a breakdown as to when they have to be repaid. So what percentage of them are 6-year bonds?
No, they will be repaid on a waterfall basis. So as the loans and the mortgages are repaid, the bonds are repaid. So it just one matches the other. The cash flow in.
No, I accept that, but legally, the minimum duration you're saying of a bond is 6 years.
Yes.
What percentage of the 900 million is 6 years? Can you give me a breakdown as, we'll say, half of it is a bond that matures 20 years' time? I just need to just get a handle on that, quick handle on that.
Well, those dates are not in such a fashion because all the bonds will repay on the same basis.
No, you're still not answering my question. Legally, I'm interested in matching long-term funding with long-term
bonds,
loans.
in effect, don't have a maturity date per se. There isn't a 6-year maturity date or a 7-year maturity date.
But is there a minimum maturity date?
Well, the structure itself, the minimum term of the structure itself is 6 years, minimum. But in fact, it could go to 2057.
But could the bondholders turn around in 6 years' time and say, we want our money back?
It's not that they want their money back. The vehicle itself would have to be refinanced.
So the question I'm asking is, could the bondholders that provide the 900 million come along in 6 years' time and say, we want repayment of our 900 million today? Yes or a no answer?
The answer is no, because there would be no cash to repay them, because the cash is locked up in mortgages which have a long-term.
So what you're saying is the minimum period they can be repaid in is 6 years' time, but to control, who does the control lie with to determine over how length of a period they can be repaid? I'm asking the question, it's a very straightforward question, that you're saying they can be repaid, it's
not repaid, Senator. It's not that they're repaid. The structure itself has assets which are long-term mortgages and liabilities which are cash.
Yes.
So the bonds themselves could be traded in the market. That's one way that an investor can get their money back. They can sell you the bond and get money from you, but the vehicle itself would still exist.
Okay.
The vehicle itself doesn't have cash that it can pay out to bondholders. It has assets which are long-term in nature, and those assets are linked to the arrangements that are in place with the customers, with mortgagees.
Okay.
So therefore, the way a bondholder can get their money is sell the bond to someone else.
And can I go up to Pepper then? So we have a vehicle that in essence 900 million is raised, that's then with Glenbeigh. They effectively use that to purchase the loans from Corporate TSB, and then effectively the bonds can be traded, they're marketable securities.
Or refinance, but yes, but it's on the liability side of the Glenbeigh structure.
But effectively Glenbeigh itself
still exists.
Fine,
exactly.
The money is there.
And just one other item, Senator.
Why are you retaining 5%?
Because we're legally obliged as the originator to retain a 5% interest in Glenbeigh itself.
As a securitisation vehicle.
And this arises from pre-crisis, the origination of mortgage-backed securitisations. Originators didn't have any interest, so they just originated them and sold them. Post-crisis, it's a requirement to hold 5% as an originator. Mr.
Ryan, in Pepper, right? Explain to me how we'll say that Glenbeigh is the provider of the 900 million towards the purchase of the loans, but yet the legal title of the loans is retained by Pepper. Do Pepper pay anything for this? How is that? Like, he who pays the piper calls the tune. Like, explain how?
Ask my colleague Dermot to answer your question.
Yeah, absolutely. So, legal title and beneficial title can be bifurcated apart. They don't necessarily need to belong to the same party. So that is what is occurring in this instance. Pepper, as the authorised regulated firm in Ireland, will take ownership of the legal title to those loans, whereas the beneficial owner of the interest, the economics of each of the loans, will vest with the...
So it's purely an administrative measure as distinct. The beneficial owner of the loans continues to be Glenbeigh.
Correct.
And the strategy and policy around loans, does that lie with the board of Glenbeigh, and who's on the board of Glenbeigh?
So I'll maybe take the first part of that question anyway. So in terms of the strategy around the loans going forward from the migration date, that will stay with Pepper as legal title holder and as master servicer to the securitisation, as long as we are master servicer for that portfolio. In terms of the second question,
I'm interested in the board of Glenbeigh. Who's on that board? Who's chair of the board? What role does the board have in terms of the loans? The board of Glenbeigh, not the operating board that you made reference to, Mr. Wright. Who's on the board of Glenbeigh?
Typically made up of 2 directors. This is an SPV structure. Primarily, like any other SPV structure, the board is required to ensure that the requirements of the company, such as adhering to Companies Acts and ensuring that all the various parts of the structure in place happen. But primarily, the activities that go on within the structure are within the master service
agreement. But within the board
agreement.
of Glenbeigh?
Sorry?
Who will be on the board of Glenbeigh?
It's a typical SPV structure where you have 2 directors. I don't have
Who
the
will
names.
the 2 directors be?
It's your typical orphan structure that whereby the trustee would appoint.
And who's the trustee?
Bank of New York is the trustee, yes.
Sorry?
Bank of New York.
And how would they be appointed as trustee? What I want to know is ultimately who will determine.
If you take it that we.
Will it be the principal investor? Will they be one of the directors?
No. They would not. No. This would be. This is your typical securitisation structure, whereby the directors of Glenbeigh are required to adhere to all the corporate requirements of any Irish company, but then they delegate responsibility to different parties to effect that.
But ultimately, is it correct to say that the overall beneficial ownership of the loans vested in is in Glenbeigh, and ultimately, under normal company rules or whatever, the board of Glenbeigh are the have ultimate beneficial control over the operation of the loans? Beneficial ownership of the loans, am I correct?
Yes, so the beneficial ownership, the beneficial ownership of around the loans itself, because the loans are the assets and the income streams that form from those, are owned by Glenbeigh. So
I'm still not happy about it. As I'm an accountant, but I don't fully understand the board of Glenbeigh, how that operates. And if an ordinary person is looking in and they're a mortgage holder, right, they've got a letter. In my world, he who pays the piper calls the tune. It's just the way it is. So I would like to know, if I'm landing up 900 million, I'm not going to hand over control of 900 million and say, Pepper, off you go there, manage that. I will ultimately want to know how my money is being invested. And under the prospectus, what's the percentage rate of return is offered under the prospectus to the bondholders? What were you offering under the prospectus that they would receive?
Well, there's a range of returns based on the note.
But what, on average, what's the rate on the note?
I will come back to you on that question.
Mr. Crowley, that's a critical point, because ultimately the rate of return, I'm assuming that's a dividend paid on an annual basis or an interest paid on an annual basis.
Correct.
So therefore that will determine, that money will have to flow up from Pepper to service the cost of servicing the bondholders. So, I like the fact that it's long-term nature in terms, and the money comes into Glenbeigh and that money is available, which will be handed to Pepper, and effectively at some future point, if Pepper deal with the loans and you over time, and I suppose the question I'm asking is, if there was to be a further securitisation of the loans that Pepper take control of, who would determine whether those loans could be sold on as a further bundle in their own right? So there's 900 million loans coming under managementship of Pepper, and let's say, for argument's sake, who makes the decision, or can they ever be sold on, or do they have to be effectively worked out over the whatever length of time? You said roughly, am I correct, that 80% of the loans are plus 10 years, and 50% of those are plus 20 years.
To run to maturity.
So the question I'm asking is, in terms of the workout of those loans, could those loans be sold on to a further securitisation? Who would make that decision? We're acting really on behalf of the mortgage holder. How will that work? I'm just taking it to a logical conclusion. I like the long-term nature, but I have to do the logical conclusion.
Yeah. So I might, in terms of the future securitisation point, I might defer to Eamon or Dermot, but I'd just like to go back.
The question I'm asking here really is, in 6 years' time, the earliest to repay that bondholder is 6 years' time, right? So in 6 years' time, the board of Glenbeigh might make a decision that they wish to sell on the portfolio to another investor. So let's say there's 800 million left of it. That's sold on. Money comes back into Glenbeigh. The investors in Glenbeigh are repaid their money. So it's a conduit to effectively not appear to sell the funds, but ultimately it's the same net impact. So I want to understand, can that happen? So in 6 years' time, could Glenbeigh board take a decision that we're going to sell on the whatever of the loans are remaining to a fund? Glenbeigh's the money is repaid, and effectively Glenbeigh is wound up, but the mortgage holders find themselves with a fund rolling on. Could that happen?
Well, typically it's the note holders who decide that, not the board of Glenbeigh. The execution of it would be at Glenbeigh in order to affect the legal aspects of it. But note holders in securitisation vehicles, and I'll come back to your specific
when you
question.
say the note holders, what do you mean by the
people
note?
who have funded, the funders,
the bond holders,
the bond holders, no bond holders.
Yeah.
They have powers with regard to the structure and how it is managed.
That's fine. They're like shareholders in any company.
They're a key party to the. They're a key party to the decision.
My question is a very simple one. It's 6 years is the minimum period that they have to be repaid.
Not repaid, Senator. That's
sorry,
not the right.
No, 6 years is the minimum period under which they could be repaid. They could be repaid. So the question I'm asking is, in 6 years' time, could the bondholders make a decision that they've deciding on the portfolio that's been managed by Pepper to sell that portfolio onto a fund? Could that decision be made at the time?
The bondholders would hold power with regard to that after 6 years. So it is possible, but the reality of these transactions is they are long-term in nature. The investors are not into short-term workout or anything of that nature. It is long-term cash yield that they're interested in.
I would like to give reassurance to the mortgage holders that are going under this mechanism through Glenbeigh and being managed by Pepper, that they would have the assurance that their loans would be worked out. Pepper are Irish-based. You're one of the funds that have, I will say, experience in the mortgage area. You're providing mortgages. So that's what I want to give the assurance.
Senator, if I could take that. So I think absolutely what your question is putting consumer protection. What are we doing?
Yes.
What's in place to protect the consumers?
This has been put forward as a long-term vehicle. I want to see how that manifests.
I think if you separate, so you have the vehicle and you have the bondholders. The vehicle itself will continue to hold the loans even if the bondholders change the background. I think we've established that. I think to make it simple, there's probably a double lock or a triple lock that actually protect the consumers behind this. In its simplest terms, and I'm going to simplify, the assets that underpin Glenbeigh are the 6,000 borrower relationships, effectively, in simple terms, rounding up 4,000 split loans and about 2,000 par capital and interest loans. That's what makes up the assets that underpin Glenbeigh. Effectively, from a consumer perspective, if we look at it through that lens, which I think is quite important to do, number one, regardless of who owns the loans, regardless of who the bondholders are, regardless of what vehicle owns them, their contracts, their original facility agreements, and any future alternative repayment arrangement which carries the full weight of law are protected. Those contracts cannot be unwound. They persist. There are, as the Deputy said, some carve-outs in terms of if there are material changes, but the actual contractual rights can be enforced in law. So that's one protection that, regardless of ownership, sits with and protects the underlying customer. The second point to make is all of these, be they split mortgages or be they par capital and interest, have been restructured. They are ARAs, so while they're performing against their new terms, strictly speaking under the regulatory code, they still fall under the protections of CCMA. So ultimately, everything around CCMA in terms of how we conduct reviews, how we contact customers, how we run those reviews, how we come to alternative arrangement with them, how we conclude that actually nothing has changed and they should stay the same. Pepper are strictly governed by CPC, CCMA, and will be regulated by the Central Bank of Ireland on those. There is very little wiggle room in terms of what can happen. The only thing that really happens that changes things is have the individual circumstances of that customer changed. The third protection, which I think also should be borne in mind, is if it moves to another loan owner. By law in Ireland, if it's a loan owner or an unregulated loan owner, they must have a regulated entity in Ireland servicing their loans. It is not legal for a loan owner not to have a regulated entity, be it Pepper or somebody else servicing those loans. And again, by regulated entity, they need to follow all the rules of CCMA, CPC, SME and all the other codes as they're applicable. So in summary, regardless, and your questions of ownership are I think have hopefully been explained, but at the centre of the vehicle, the question is what's in place to protect the consumers. The contracts will persist, the regulatory codes, because they're ARAs and under protection of CCMA, will persist, and ultimately, if they do move around, any loan owner has to appoint someone like Pepper or another regulated loan owner that will be overseen by the Central Bank.
Thank you. Just
Thanks very much,
a tiny bit. The biggest worry is there's a concern, a perception amongst the public that many of the funding vehicles are themselves borrowing of short-term in nature. So they're borrowing money to buy loans. The appeal of this is that the money that's being put in appears to be long-term in nature. The question I'm asking is, and obviously if they're worked out long-term by Pepper, then that squares the circle. If they're potentially sold on to another fund in a relatively short period of time, and that fund itself, its funding is short-term in nature, that brings about concern for mortgage holders, hard-pressed and permanent TSB. I think that's a reasonable proposition. It's something that I think needs to be addressed. Thank you.
Just to follow on from that, Colin, Deputy Doherty now, but I just note that in media coverage, it suggested that PIMCO, one of the world's biggest bond investment firms, are the ones that will acquire most of the notes in this regard.
From a PTSB perspective, as per Pepper, we signed a non-disclosure arrangement, which brings obviously responsibilities both to the bank and the directors. So we're unable to provide ownership today of the ultimate investors.
Okay, we'll come back to that. Deputy Doherty.
Thank you, Chairperson. We're here about an hour and 20 minutes into this committee, and to tell you the truth, I haven't found out much information. We know that your bank, Mr. Masding, is abandoning and breaking commitments that you made to your customers, people who are meeting their restructured payments, and you're offloading them to a vehicle which was set up last month down in the IFSC, which is two directors, which are directors of about 300 other companies, because they're just an agency acting on behalf of Wellington Trust. And the owners, the real people who have the power behind this here, we don't have a clue who they are. And that's the reality. You are abandoning a state-owned bank, and the Minister for Finance should be the person who's in here, because the fact that he consented to this new law in Irish banking, where we have people who are meeting their arrangements and allowed them to be sold onto a vehicle which was established last week or last month, two shelf directors on it, and we don't know who the owner is. And Pepper are here, who are there, just doing the administration of it. Like, with all due respect. With all due respect. And it's a nice wee vehicle that's established, because you've established in a way that you won't pay a penny tax. Under the rules that we spent time and weeks and weeks in relation to closing loopholes so that funds like this, Section 110 funds, would actually pay tax on interest, you have found the way around it. Isn't that right, Mr. Masding? Because of the fact that you will hold 5% of the beneficial interest in this fund, it will now exempt you from tax in relation to the interest, or exempt the whole vehicle from tax. Is that not the case?
Eamon?
No, we're required under law to hold 5%, Deputy. That's the requirement. It's
well, the fact that you hold 5%...
It's nothing to do with tax.
Well, the fact you hold 5%, exempt the SPV vehicle, which we don't have a clue who owns it, exempt them from tax. as a Section 110 company? Doesn't it avoid, and doesn't the prospectus specifically mention the legislation that we introduced in this committee to actually close this loophole that in the perspective you said a way around it because of the fact that Permanent TSB, as the originator of these loans, will hold a beneficial interest of 5%. It's not in the prospectus black and white. If you don't want to admit it to you, I'll read it out to you if you want.
We're required as the originator to hold 5%, Deputy. That is the requirement of being an originator.
And does that fact allow this vehicle, which you will have 5% interest in, and whoever else the bondholders are will have the other 95%, avoid them paying tax as a result of Permanent TSB holding the 5%?
As originator, we're required to hold 5%.
Do you know the answer, or are you just going to repeat that point over and over again? Because I can go and read. I'll actually read it out if that's okay. On the basis of disclosure elsewhere in the prospectus, the seller is a regulated credit institution which is an originator for the purpose of Article 4 of CRR and will retain in accordance with Article 405 of the CRR an economic interest for the purpose of securitisation. Accordingly, the transaction should be a CMBS or MBS transaction and therefore exempt from the documented deductible restrictions pursuant to Finance Acts 2016 and 2017, which we worked hard to close down this loophole so that mortgages that went into Section 110 companies were not tax-free. Isn't that the case? Is it not the case that this vehicle, which Permanent TSB will have an interest in, 5%, will be exempt from tax as a result of the structure?
The reason, as I outlined to the Deputy before, for the creation of the securitisation vehicle is that we would try to find a long-term investor which would match the requirements of the customer in that regard, i.e. create the securitisation vehicle and find an investor. It was in no means to do anything with regard to tax issues.
But are you exempt from tax?
PTSB are not exempt from tax.
No, this vehicle in which you will have 5% interest in, economic interest in.
As I understand, a Section 110 company, and the regulations would apply to as such. But the core issue with regard to creating the securitisation vehicle was that we could, instead of a pure loan sale, and indeed we were here not so long ago with Loss and talking about the sale of
I know that. Look, I'm trying to get to a point, and you're really filibustering here. Maybe Mr. Ryan, because you seem to be quoting from the perspective. Would you acknowledge that in two separate sections in the perspective under the taxation heading and earlier that it clearly states that the SPV vehicle that you are setting up will be exempt from tax and will avoid the restrictions in relation to the 2016 and 2017 Finance Code that we passed in the House of the Oireachtas? Is that not the case, Mr. Ryan?
With respect, Deputy, the Glenbeigh securitisation vehicle is a vehicle that we service. I'm not best positioned to answer in terms of the tax status of the vehicle itself.
Mr. Ryan, you've with other colleagues and Deputy McGrath, you repeatedly talked about the prospectus. I have the prospectus. That's what's in the prospectus. You're able to talk about what's in the prospectus. I'm just asking you, is that not the case that in the prospectus? See, this is the difficulty. You just won't admit something that is black and white. You just won't admit it because you know why? Because the public are outraged at what Permanent TSB has done. And this is a double outrage, the fact that you're now offloading these mortgages to a vehicle which you will benefit from as the CEO of the bank, to a company, to a vehicle that has circumvented our tax codes legally, but it's done in that way, and you won't even admit it. And you're wasting my time, you're wasting the committee's time, you're wasting the public's time by just admitting something that's black and white.
So this is my 5th appearance this year, Deputy, and I would be deeply disappointed if my school report said I was wasting your time. So let me have a go at trying to answer your question, if that would be okay. So the first question then, in order to allow the transaction to happen, it was created as a Section 1110 company, and the tax status of that 1110 company comes with the design of the structure. So I can't make any comment on that. It's in the prospectus, as you say. Let's not repeat what's in the prospectus. Point one. Point two, in order for the securitisation vehicle to be incepted, and based on, as my colleague Eamon has said, let me describe it as the poor practices during the financial crisis, an originator of the mortgages, which is Permanent TSB, is legally obliged to take a 5% vertical slice. That has nothing to do with the insinuations you're making around tax avoidance. So I just want to place that on the record. That's the first point.
Hang on a second. I'm not making any insinuation. I asked the question, which nobody so far, including yourself, hasn't acknowledged. Does it not say in the perspectives that because of the structure that it will be tax exempt?
I've just acknowledged that what you say in the prospectus are the facts.
Okay.
I am merely saying, Deputy,
Appreciate
and I apologise if I misunderstood the point you were making. The second point I was making that was, in order for that vehicle to be incepted, legally the bank has to have a vertical slice of the various bonds. That would be the first point. Secondly, then, you challenged me quite correctly on those customers who, as I said in my opening remarks, have engaged with us and feel let down by permanent TSB, and I can empathise with why you are making that statement. In response, I would say the following. The bank has a 16% NPL ratio. Split mortgages and part capital and interest with bullet are NPLs as defined by the rules. As I assured the committee at my last appearance, we were looking at all the alternatives to reduce the NPL ratio, and this was, in our opinion, the least worst alternative. Why was it the least worst alternative? Number one, because we found investors who matched the duration of the mortgages. Number two, because the actual long-term treatments, they transfer in full to the vehicle and their protections are maintained. And thirdly, to the best of our ability, we find a servicer of that vehicle who is experienced in the Irish market. So in summary, your comments around the Section 1110 tax status in the prospectus are correct. Number two, I do want to bifurcate any perception that the committee might have that the bank took the 5% to take advantage of that. It didn't. It has to take the 5% in order for the vehicle to be valid. And then thirdly, whilst I'm sure we will have to agree to disagree, that is the bank's perspective on why this transaction happened, in order to reduce its NPL ratio down to a level that makes it an institution that can compete going forward.
When you say and thanks for actually giving me an answer in terms of that it will be tax-free, and that's what, this really pisses a lot of people off, because there's investors there that will be multi-billion euro investors. 95% of the profit made from this securitisation vehicle will be tax-free. Like, you know, they're the ones who are, it'll all be tax-free, but they're the ones who are benefiting from it. And they've found a way, and we have a state-owned bank who's participating in this with the consent of the minister, and that's what's really, really annoying. And you know, it's in the perspective. It's a nice wee boast for bondholders. You know, it'll be tax free. But the question I have for you in terms of the 5% that permanent TSB will hold in terms of the acquisition and holding 5% of the notes, will you, when you say you acquire them, will you have to purchase them?
Well,
or do they come automatically within the sale?
I'll let Eamon answer the specifics. In terms of the first one, I would understand the perception you make around taxation. I have to play within the rules that I'm given. I'm neither the Minister for Taxation nor am I the European authority in terms of setting the tax rules. I'm merely saying to you that the securitisation vehicle was set up in a certain way and we have to take 5%. So, Eamon, do you want to talk about 5%?
The consideration we received is cash plus the note itself, plus the 5% note.
So it's the 890 million plus the note itself?
No, the note's included in that 890 million.
So that it comes with 5%?
Yeah,
yes.
the consideration, it's a consideration of cash plus the note. So we don't purchase it, it was issued immediately.
Okay, okay. So the bank will receive 890 million plus 5%.
No, within the 890 million, the note's included.
Oh, so the note's included, so you would have to really deduct 45 million in
effect, yes, in round numbers, yes.
So the loss of this to the bank is actually greater than what we would have seen, because...
No, the 45 million have a value, they have a value stay, yes.
Yeah, I understand that. Yeah, but the perception would be that it would be that it was greater than that because there would be a 5% shareholding.
The sum of cash plus the
note,
the vertical note.
Can I ask you? You talked about operating within the rules and operating within good faith and all the rest. Can I ask you, did you apply the code of practice on mortgage transfers to this transfer?
Sorry, repeat that again.
Did you apply the Central Bank of Ireland's code of practice on the transfer of mortgage to this transfer? You're transferring what, over 6,000 mortgages.
That's correct.
So the Central Bank of Ireland's code of practice on the transfer of mortgage, did Permanent TSB as a state-owned bank apply that code?
Well, at this moment, Deputy, we haven't actually transferred the mortgages. They will transfer on the basis of the legal title transferring, and that will be in 6 months' time.
Do you intend to apply the code of practice on the transfer of mortgage?
Of course, yes.
Of course. Excellent. That's good news to everybody here. Let me read you the first line of the Central Bank of Ireland Code of Practice on the Transfer of Mortgages. A loan secured by a mortgage on residential property may not be transferred without the written consent of the borrower. You are going to apply this?
Well, we have interacted with the Central Bank with regard to this transaction quite extensively.
Mr. Crowley, you told me, of course, you were going to apply the Code of Conduct on the transfer of mortgages. It says clearly, it's been here since 1990, it says clearly that you can't, it's voluntary, but it's up to you to apply it or not. You've informed this committee that you're going to apply it. It's here. The Minister for Finance believes that the former Minister for Finance believes that every bank should apply it. He gave that written response, actually, interestingly, to the current Minister for Finance when he tabled a parliamentary question a number of years ago. So, the Code of Conduct, on the Code of Practice on the transfer of mortgages says very clearly that no bank should transfer a mortgage on residential property without the written consent of the borrower. It keeps on going on. It stipulates exactly what you have to do in terms of the written consent. It stipulates how you have to, the undertakings, the information you have to provide if the individual doesn't give written consent, the interest rates, all of that. So, do you want to, are you still of the view that you are, of course, going to apply this?
Well, we have written consent already from borrowers with regard to the ability to transfer loans already. It's already in our documentation.
No, that's not what the Code of Practice says. I will go through it if you want. When seeking a consent and where there is to be or where there has been an arrangement with the original lender, the service of the mortgager as the agent of the transfer, the lender will confirm that the transfer policy and the handling of arrears and the setting of mortgage interest rates will be the same as the original lender. It's not like you have to write a letter to them. You have to ask them for their consent. You have to state in that letter, for example, the last point in paragraph 4 is confirmation that the absence of specific consent, the existing arrangements will continue to apply. There's a lot of other things you have to do, which you haven't done. You've not done it here, you've not done it with Project Glass, you've not done it at all. You've turned your nose up at the Central Bank of Ireland's Code of Practice on the transfer of mortgage. So can I ask you again, are you considering in this case to apply the Code of Practice that the Central Bank has and has for the last 2 decades?
Well, as I mentioned, Deputy, we have engaged extensively with the Central Bank with regard to this transaction and with regard to Gloss as well. You know, we'll follow all required procedures and that are legally required. And indeed, as I mentioned, there is already consent contained in the mortgage documents we have today.
Okay, so this is a code of, Mr. Masding, you're the top guy. This is the Code of Practice on the Transfer of Mortgage. First line, I'll read it to you again. A loan secured by the mortgage of residential property may not be transferred without the written consent of the borrower. You're a state-owned institution. Yes, this is voluntary. I have legislation which I'll be tabling in the next number of days to make it mandatory, to make it statutory, and hopefully we'll close down this sale, but we'll cross that bridge when we come to it. But this is the code, supported by the House of the Oireachtas, applied by the Central Bank. You're a state-owned institution. Will you apply the Code of Practice?
Thank you for your question, Deputy. Voluntary is the key word. In this particular case...
It actually, sorry, my apologies, the code doesn't say anywhere that it's voluntary. It doesn't say anywhere that it's voluntary. It just doesn't say that it's statutory. That's the only thing. It doesn't say so. Because I take it that you weren't familiar with the code, but just to make that point.
The bank believes that its origination documentation allows it to undertake the transaction, number one. Number two, in isolation, I obviously recognise what you're saying, and just allow me to come back to you. I just need to just check, but from my perspective, the origination document is the governing document. Secondly, I don't want to avoid the point that, as we've discussed before, our NPL ratio, I'm afraid, Deputy, means that we have to undertake this transaction. I'll come back to you in a second, but my opening comment would be that the loan facility letter is the governing document which allows us to undertake this transaction.
Can I say to you that the Code of Conduct on Mortgage Arrears, the bank applies it, doesn't it?
To the best of our ability, yes.
Yeah, okay. Although within the original contract there is no real requirement for you to engage with those type of measures, that you would have legal rights to do certain things. But the Code of Conduct limited those rights in a certain way, and you comply with it. Isn't that correct?
We're always looking for right customer outcomes, Deputy, as we've discussed in the past. I think we might be forgetting here that back in 2012, the level of long-term arrears which PTSB had actually made it an institution that absolutely required to undertake the level of long-term treatments that we did. I think we sometimes forget that the alternative was scale repossessions, and I just want to place that on the record.
That's fine. No, the point I'm making is that, like, you know, it's a state-owned bank. The public own this bank.
They own 75%.
Yeah,
of course,
75%. We're majority owner of this bank.
Of capital market shareholders, yes.
And I'll finish on it. Well, let me go to one point after this. But I just want to make the point again. You're completely disregarding this code of practice on the transfer of mortgages because it doesn't suit you. This is something that was agreed by the central bank. Like, this isn't, you know, coming from the far left. This is something that's in place, but you're deciding doesn't suit us. We know if we went and asked our customers whether they would give us consent, they would tell you to take a jump. Not a chance.
I'm afraid we would probably have to disagree on this point, but from where I sit as the Chief Executive, it would suit Ireland a lot less if PTSB maintained an NPL ratio of 16% and was unable to compete, and the consequences of an economic downturn became, had an impact on the functioning business of PTSB. Ireland would actually like that a lot less, I think.
Well, I'm talking about your customers for a start, and I won't go into the fact that the bank and the mess the bank did in relation to the split mortgages, and how your split mortgages are defined as non-performing, yet other banks who got it right are not defined as non-performing.
I answered that question previously, and I answered it in my opening remarks.
Can I ask Mr. Ryan, and finally in this here, Mr. Ryan, the big concern is when banks are selling to the vultures, that there isn't a long-term interest. Like, you are an agent. Look at the perspectives. That this can be sold at any time. Indeed, you can be removed as agents at any time by this vehicle, which we have no idea who owns. So the big concern here is that certainty. Whatever about people's opinions of high street banks, they know that the bank wants to be here in 30, 40 and 50 years' time. Now, Permanent TSB structured their split mortgages in a way of which they went up to 80% warehoused. Now, you're saying that unless things change, that you will continue to honour those split mortgages all the way through. What does that definition of change mean? Does that mean if somebody has increased, because this goes into legal test, if somebody's wages would increase, for example, by 2 or 3% according with inflation, does that allow you to then have the review? Because, you know, nobody, like, they don't have trust. They don't have trust in you. That's the reality. Like, and they definitely don't have trust in this vehicle that owns their loans now, because sure, the vehicle didn't exist 30 days ago. You know, like Bank of New York, Mellon and Millington, and these are all. This is a shelf company. This has got a registered address with another 136 businesses down the road there. Like, there's no face to this. Like, Pepper has come in here for the first time after a long challenge for us to try and get you in. But the people who own these loans are faceless. Absolutely, we have no idea. So can I ask you in terms of the review, and what does that guarantee mean in terms of change? Obviously, people's circumstances will change, and we hope for the better. Nobody is going to stay exactly in the same position. So what guarantee are you giving to people? And when you say there's a legal guarantee, can you specify where that legal guarantee is? And the last thing I want to ask this year is, can you outline to us, in relation to the operating committee that you talked to, you were answering Deputy McGrath, where in the perspectives, if you can actually dig out, where in the perspectives deals with that issue, if you can give us a page reference. Thank you.
Okay. So in terms of the review period, thank you, Deputy, for your questions. If I answer the review period is talking about the restructuring arrangements. As I said at the beginning, the majority of the mortgages are either split 4,000 or so and about 2,000 or so are part capital and interest. The review arrangements are a standard part of the T's and C's. Reviews were going on with PTSB, and they're a standard part of any restructuring arrangement. The first point is on frequency, which I think I've addressed already. Like any rearrangement and like any ARA, alternative restructure arrangement, we will look at a range of factors. The first thing I'll say is every single case, in reality with our consumers and under the CCMA code, is unique. No two cases are the same. The factors that we take into account, and they're under the CCMA code, are, number one, what is the overall indebtedness of the customer? And for somebody who hasn't been reviewed in a number of years, that may have changed. Number two, what is their financial situation? Are there two people working in the family? Is there an additional person working in the family? Has the person got a new job? Three, it looks at their personal circumstances. Do they have dependents? Are there other pieces that are, I guess, draining on their income? We form that overall picture, and then we take a view, and there's basically three outcomes that can happen. We run that through our affordability assessment, and that basically will say what a customer can or cannot afford. But effectively, there's three outcomes. One outcome is, when you take everything together, nothing has really changed. Even though, as you said, thankfully we're in a much better economy now than we were 5 years ago or 10 years ago. The customer may be in the exact same circumstance. If he's in the exact same circumstance, it's a fairly short conversation where we will say to the customer, you should stay in this arrangement. Nothing should change. If the customer, for example, had received, and I want to talk about this in real terms rather than the abstract, if the customer had received a promotion, was earning more money, if their partner was starting to work and there was additional income coming into the family, which was attributable to the property, we then, working with the customer, might say, well, actually, there is some additional affordability. This was your affordability on the previous circumstance. There's now increased affordability. And linked to our obligation to be open, fair and transparent and to have the customer's best interest at heart, we would say, you have a big bullet payment at the end. That is how these mortgages are structured. I didn't structure them that way. That's how they're structured. And we might say, you have X amount due in, as I said, 10 years, 15 years, 20 years. We think the right thing to do, and in your best interests, is to increase slightly what the monthly repayment is. And to bring it back to an example, that could make a difference over 20 years between that customer having 50 grand at the end of their mortgage and, let's say, 10 grand due at the end of the mortgage. They're rough numbers, but it could be something like that. And we may say to the customer, we think that your arrangement should stay in place, but we should make a slight tweak to it because actually it's in your best interest. So that's one example of how that might change. Going back to our obligations, I and my team of specialists to do that, and most of these people have been doing this for 7, 10 years, have to be able to stand over that arrangement. We will have internal teams who will quality assure it. They will look at all the documentation. Did we actually document the numbers correctly? Did we explain it to the customer? Did they understand what was happening? And every single one of those arrangements and any change is absolutely subject to the review of the CBI.
The exact same model used by Permanent TSB?
Yes.
Exactly.
Sorry. It will be as governed by the CCMA code. The SFS, and I'm sure you've seen it at the back of the CCMA, is quite prescriptive in terms of inputs and outputs.
But if you're not using the same as permanent TSB, there will be a difference.
It's highly unlikely there will be a material difference. Yes, there'll be different models. We do not use the same spreadsheets. From a CCMA point of view, they are quite specific in terms of what you do. The last point I wanted to make, as I said, there was 3 outcomes, is there could be a material disimprovement. I think where we are, most people have either been neutral or have improved. But obviously, again, every circumstance is different. And if we come across a customer where their circumstances have regrettably disimproved, then we need to work with the customer to deal with that. We would look at the ARA. We would say, is the split as currently arranged suitable, or actually do we need to make an additional change to the portfolio to make it affordable? So all those 3 outcomes are available.
I asked the operating committee in the perspective, so you might be able to answer that. Where does it refer to that in the perspective?
So the operating committee, it's referred to in a few places. I will refer to page 167 of the prospectus, which does refer to the fact, and I'll just summarise rather than, in the interest of time, rather than reading the whole paragraph. The very last line says the final determination of all such matters shall be made by the master servicer acting in accordance with PEPR's policies. And there are various references through the prospectus. I'm happy to come back to that, Deputy.
Okay.
Sorry, Deputy, I need to just conclude my answer to the question you gave me. So the code is voluntary, as you stated. The governing document here is the terms and conditions of the loan agreement, which gives us the right to assign the loan. So in that case, the balance I have to make is between that voluntary code versus the NPL ratio, versus trying to find the least worst outcome for the customers. And I suspect we're not aligned here, but in terms of the transaction that we have tried to design, the treatments continue, protections of those treatments travel with the loans, and they're serviced by PEPR. So, and then the bank's NPL ratio comes down. So I'm sure we're not aligned, but they're the reasons that I would give in answer to your question. And in terms of section 1110, I apologise if I was appearing to obfuscate.
Senator Conroy.
Thank you, Cathaoirleach, and thank you for your presentations. And I thank you for coming in here today, because I think there's really important questions to be answered. And I suppose the first thing to say is it's very difficult to believe that the Minister for Finance had no objection to this sale and facilitated the betrayal of vulnerable Irish customers. And I think what's particularly interesting about today is the fact that many times the banks have come in here and it's been stated, well, you know, we can't let people off without paying their mortgages, you know, because the other people are responsible and they pay their mortgages and others are just basically not bothering to pay their mortgages. But the thousands of customers that we are here and citizens that we are here to talk about today are all people who have made the very best possible efforts to pay their mortgages and have come to arrangements with the bank, whether it be split mortgages or other arrangements. So these are responsible citizens who want to pay their fair share and keep their homes at the same time. So they're looking at this from a couple of different perspectives, and what they want is they want to be able to trust who has the deeds to their homes. They want certainty and they want security. So maybe just a couple of things to try and establish some of that. The first thing is I just want to come back to the tax situation and the section 110. PEPR have, what is it, 10 billion assets in Ireland as it is now?
So for residential mortgage loans,
yes.
Before the Glenbeigh transaction, we have 50,000 loans, so 64,000 overall. 50,000 of those are effectively mortgages secured against property. Post the Glenbeigh transaction, the value of those loans that we'll manage and administrate and service on a day-to-day basis will be approximately 10 billion euros.
And how much tax did you pay last year, leaving aside the income tax from your employees?
So I don't have the exact numbers. I might defer to my finance director. But what I will say is, and again, just to clarify, in terms of our role, we're effectively in this and with some of the other clients that we have, a service provider. We provide us services, we take a fee. These assets and the 10 billion of loans I mentioned are not in our balance sheet. The Glenbeigh loans, the 6,000 loans within the Glenbeigh security vehicle, we do not have an economic interest in that vehicle.
So they have the economic interest, and have we a way of knowing how much tax they paid? I think it's just, I'm just trying to tease out, but see, all of these thousands of customers that we're dealing with here, they all pay tax. They all pay a lot of tax every year. And they would want to know that the people that they were paying their mortgage to also paid a fair share of tax. So I'm just trying to establish.
Yes, so I can confirm from a Pepper point of view, we are absolutely tax compliant. We're a registered
Well, I would think that you would in being regulated and all that,
yes.
but I'm just trying to get at a figure of how much. So an entity that has 10 billion of assets, how much tax do you pay in a year?
Well, the tax could be confirmed by looking at the accounts of each one of these SPVs. I wouldn't know myself because, as Cormac has mentioned, they're not part of the Pepper Group. We don't consolidate these vehicles. We are an agent of them. We have a contractual relationship with them, but we're not responsible for their taxable basis or their compliance.
Yeah, and you see, this is the problem, you see, for the community, the consumers at the end of this food chain is who's what and who's where and who's responsible for this and who's making the money out of it. And, you know, you've had a write-down of what in the loans of what, £500 million?
Maybe I'll try and I think you're talking to the wrong people here, right? Glenbeigh is a special purpose vehicle.
But they would...
Pepper,
Yeah.
Pepper is the servicer.
Yes.
They are tax compliant. Permanent CSB is a public limited company in Ireland.
I
Within the rules
understand
that we are,
Mr. Masding.
we are tax
Yes.
compliant. Now,
Yes.
the tax affairs of Glenbeigh or its investors,
Yes.
I don't think either of us.
Who we don't know, and this is the see, this is the problem for consumers, is that we don't know. We have these people, fairy people out there who are benefiting from all of this, while we have these consumers who are at home and they're worried about their mortgages, they're worried about, you know, how this is going to pan out for them at the moment, you know, will they be able to keep their homes and all this, and yet we have the beneficiaries of their mortgages that have been sold off by yourselves, and they don't know who they're dealing with. They really don't know who they're dealing with, because you're only the vehicle in the middle, if you like. That's what you're saying.
Yeah, again, just to clarify your points and just hopefully just to help answer the question, Senator, in terms of they're dealing with us, you're absolutely right. The economic interest of the loans in terms of the actual asset value of those is held separately in Glenbeigh Securities. That is separate to Pepper, and Pepper doesn't have an economic interest in the loans. But what I would say again is, just to try and explain it further, the people they're dealing with, there's a difference between ownership and kind of day-to-day management, decision-making and control.
I understand all that.
Yeah.
I do understand it, honestly. I do. Okay,
You
I want to
made,
get to a few... Okay.
You made two other observations in your opening remarks that I'd just like to respond to, please. So the first one is you used the word betrayal, and just for the record, I absolutely don't accept that phrase.
That's okay, but that's what consumers and customers are telling us, that they feel betrayed.
So
they feel betrayed.
You used the word...
And that is really important to acknowledge that.
You used the word betrayal, and as I have tried to explain to you, we try to find a way that the customers who would engage with us could keep their long-term treatment and could be protected by the laws of the land, and we think we have achieved that. Secondly, you asked me again about the consultation with the Minister for Finance, and again I should repeat to you that it was a consultation where we followed the obligations that we have under the relationship framework, and they were followed to the letter of the law.
Except for the code of practice of the transfer of mortgages, as was specifically outlined.
And
I would have thought that would be the first document you'd have on the table.
And I've just answered that question insofar as that code is voluntary. The overriding and governing document here is the loan facility letter. And as I tried to explain to you, we're trying to get as many moons aligned as we can, where one of those moons is as a management team, as the chief executive, I have a bank that has a 16% NPL ratio, and that's not
Yeah, I
sustainable.
understand that, and we met with the ECB, and the ECB explicitly told us they weren't putting pressure on the selling off of loans. They too appeared to be concerned about what was happening. It wasn't to work through these loans. These loans are performing loans as far as we're concerned, in being split mortgages with people improving their circumstances and meeting their obligations. They are not reckless people. They are not reckless in the way that the banks in this country have been. These are responsible citizens who are trying to hold the roof of their homes over their heads for them and their children, and that is the bottom line, and they're the people we're here to represent. I want to ask you a couple of questions around, like, you see, they will find it difficult in dealing with Pepper. They looked at all of the banks when they were taking out their mortgages. They looked at the bank that they thought would most service their needs, and that they made the decision it was PTSB. Now they find themselves with an operation that's operating in Australia, Britain, Spain and South Korea. And they want to know, right, okay, how all of that is going to impact on them. First of all, I'll just ask you a very simple question. Where are the deeds of their homes going to be held? The actual deeds.
The deeds of the homes will be something that will be managed and administered by Pepper. That's a standard.
Where will they be held? Where will they be physically held?
In different, for different arrangements, they're held in different places. I can just check.
I really want to know that.
They'll be held in Dublin with our standard provider.
They'll be held in Dublin?
Yes.
Okay, where in Dublin did you say?
I don't have the exact location. Okay. I haven't got the exact location. We have a third-party supplier whose name I'd prefer not to use, but we use them all the time. That's where their deeds are held.
You see, I think it's very important that people know exactly where the deeds are going to be held.
I can come back, Senator, with the details of that.
They also want to know if they've had a review with PTSB, say, in the last 3 months, okay, and they would have 3 yearly reviews, that would be the norm in PTSB. Are they going to have a review with yourselves within that period of time? Or are you going to wait until the 3 years is up and have a review at that point?
The answer to that, if that's directed at myself, Senator, is it depends. I'd go back to the contracts. The contracts, in some cases, say at least triannually, so that doesn't mean every 3 years, it means at least triannually. Other contracts, it's open. To go back to your example, if someone's been reviewed in the past 3 months, they're unlikely to be first on the list.
Okay, but you see, if we're saying that, this is what I want to get straight, if we're saying that everything is going to be the same, so people who got letters in the last few days are saying everything is going to continue the same, and straight away we're saying that everything up to now has been reviews every 3 years, and straight away we're saying, okay, now the reviews may change, so you may have a review in 6 months' time again. So it's not the same, you know what I'm saying?
There's no specific review time period. We chose 3 years. And indeed, I would assert that I would probably have instructed my team as the mortgages got nearer to their maturity to actually increase the frequency of those reviews. Why? Because that reduces the likelihood of a poor customer outcome. Because those warehouses and those bullets are due. So there's no specific time period per se. And I think I suppose the point I'm making, and I'll let Cormac obviously comment from Pep's point, the point I'm making is that I actually feel those reviews are a positive conversation, because those warehouses are material amounts of capital, and that they are due. And to have a conversation with a customer to try and help them move the warehouse or the bullet into the main mortgage, and therefore reduce the risk of maturity is a good thing. And so that would be the bank's perspective.
Can you understand, Mr. Masding, can you understand the fear that people have right now? The fear that people have around their homes and what might happen into the future when they're dealing with an unknown entity who we don't know is profiting from it at the end of the day. We don't know how much tax he pays, or whether it's a she. I'd imagine it's a he. But so that's the fear. It's the fear of the unknown that's there at the moment that we're trying to get to the bottom.
I absolutely understand that, because let's cut to the chase. These customers engage with Permanent TSB. They engaged with permanent CSB.
They trusted PTSB.
And they had a conversation with us that led to a long-term treatment. So, of course, I can understand that. I think, to be frank with you, that was the reason that we volunteered to come here, because we wanted to do our best to assure those customers that the structure we put in place allows them to continue with the treatment and to have the protection.
I appreciate that. And so we're all on the same side, we're all on the same page in relation to that, because I'm trying to do the very same thing. So when we look at, and you know, I like your statement in terms of Pepper, we look at the person, not just the paperwork, which is really good on the face of it. So I want to reconcile that with Pepper's failure to pass on a single cent of rate cuts for the variable rate mortgages over a 5-year period. So just reconcile those two for me. So the ECB rates, obviously, the ECB rates were cut and all of that, yet Pepper did not pass on any of that to the mortgage holders.
Okay. To answer the question, I think, firstly, Pepper run portfolios for various different clients. So we currently have 50,000 mortgages. Every single portfolio will be different. Ultimately, what a customer is entitled to and their rights are protected by the terms and conditions of their contract. I am talking about something which I think is many years ago. Fortunately, we've been in a very low and zero interest rate environment for a number of years. So I'm assuming the case
2012 to 2017, that was the 5-year period, was
Yes. So in terms of the customers, I understand the customers were all on standard variable rates.
Yes.
Standard variable rates are different to tracker rates. Tracker rates absolutely by law need to move up and down. Again, it's a point before my time. My understanding is it was standard variable rates. Standard variable rates, be they with any bank in Ireland or outside of Ireland, the ultimate decision in terms of the rate to be passed on to the customer sits with the bank or the legal title holder. That there is no obligation.
So would that sit with yourselves then in this case? Would it have sat with Pepper himself?
So if we
Pepper
talk
would
about,
be to make that
so
decision of whether we're going to pass this on to the customer or we're not.
So if we talk about lend-based securities, when all of these mortgage loans come across, ultimately it will be Pepper. And again, the prospectus is clear that Pepper will be making decisions on the standard or variable rates, and they're quite a big proportion of the book, both on the splits and on the par capital interest. There are many factors, like any other financial institution, that go into the SVR, but there absolutely will be an ability, if ECB rates go up, like every other financial...
I know we're talking into the future, but you didn't really address my question in terms of trust and in terms of how you can reconcile. We look at the person, not the paperwork. Do you think it was fair not to pass on... see, what I'm trying to get at is, you're obviously an organisation, a company, and your aim is profit maximisation. I get that. That's how the world operates. But... so therefore, you would do something like not passing on the interest rates. So how can customers, based on that past record, even just that element of it, how can consumers, people who you have the deeds to their homes, trust you going into the future? Based on that, just explain why you might not have, over a 5-year period, thought, well, you know, we're making enough profit here, we're going to cut a break for our customers.
Yeah. Again, to answer the specific question, in terms of the case, that is on a specific portfolio, so it doesn't apply across the whole Pepper portfolio. I understand, and I will need to check, these customers were on standard variable rates, not on tracker rates, if that's a discretion of the holder. I also will need to check, and I'm happy to come back with the exact detail. My understanding is Pepper were not the sole decision maker, as we would not have been the beneficial owner in that circumstance. So it was on a single portfolio, not across all the portfolios that we manage. I need to clarify the exact decision making. Again, it was before my time, so I can't give you an exact answer. But I think more importantly, given we're here to talk about Glenbeigh and what does that mean to the future of Glenbeigh, the difference here is in the future, and again, it was part of what I said in the opening statement, the setting of the standard variable rates will sit and has been delegated to the master servicer in this situation, which is Pepper. Pepper will have the ability to move rates up and move rates down. I can't give you, the future is the future, and many people have made mistakes in predicting interest rates. But what I can confirm to you is A, that's our capacity, and B, we will have the ability to move rates up and move rates down.
Yeah,
as any
I'm just
other.
trying to, I suppose, demonstrate that while we are told certain things here, then we have to look at a record, and in terms of the representation. I just want to, the tracker rate, obviously, it goes without saying that anybody on a tracker rate will follow that through because you're legally obliged to do it. So there isn't a discretion on that.
Your time, Senator.
And I'll just finish with it. On the standard letter that you've sent out, PTSB, is that letter legally binding for people who have those letters that says that the terms and conditions will remain the same? Is it legally binding? Yourself. You sent out the letter, Mr. Masding, yeah?
The arrangement letter, or
The letter telling people that their mortgage was no longer with yourselves and that the terms and conditions will remain the same.
yes, that's correct. In terms of the treatments, yes, that's correct.
It's legally binding?
Yes, that's correct. Yes.
Okay. I'll leave it at that. Cahill.
Senator Burke.
Thanks, Chairman. I'd like to welcome the guests and welcome the presentations that have been made here today. And just a few questions, Chairman.
Sorry, Senator, I think I might have misunderstood your question. The letter is a general letter to the customers. The terms and conditions of their original loan and their long-term treatment is legally binding.
But the fact that you're saying that within the letter, that's legally binding.
The terms
The fact
and
that you're
conditions
saying
of
that the terms and conditions will remain
the
the
original facility letter and the long-term treatment are legally binding. That's correct.
And what's in the letter? So the fact that it'll stay the same is legally. That sentence, if you like, the terms and conditions will remain the same. That is legally binding. Yes.
So the laws of the land travel with the treatment, and then, Cormac, if you just repeat what you said in your opening statement in terms of the treatments. I mean,
Yeah, so the treatments, again, I think for all of these customers, they are operating within, the two...
I understand that. The letter in itself, is that the statement within the letter in itself, is it legally binding?
I would doubt it would stand up in a court of law, but the underlying facility
It
letter...
isn't, but the finer print would be.
Yeah, that's what I'm trying to tease out, because...
The underlying
as
facility
always, as
letter and
they
the
seem.
long-term treatment are legal documents, yeah.
I know that. Thank you.
Senator Burke.
Chairman, can I ask Mr. Ryan, just for the sake of the
Thanks,
people that are looking in here today and who are quite worried about their future and how their loans will be treated and what will happen, could you outline to us, we'll say, a typical customer who may have 10 years left, who may have some legacy debt?
Yes.
They might have 10 years left on the loan, they may have legacy debt, and could you outline from once you take over, Glen Bay takes this loan over in 6 months' time, how will it operate?
So when you say legacy, you mean we're talking about a split warehouse arrangement?
Split warehouse arrangement, yes.
Yeah. So the main, as I said, and let me just repeat the assurances. Number one, the facility arrangement or the actual terms and conditions of the original loan, they come across.
That has been set by the PTSB?
Exactly, by the originator, by the bank who originally provided the loan. PTSB also were the bank that were in charge of the loan, and I would acknowledge, and it should be acknowledged in this forum, all of these customers, given they went through an arrangement, did go through a period of distress. So we are extremely aware that while they're all performing now, these customers have had issues in the past. Thankfully, they're now in an arrangement and they're all paying. I just wanted to make sure that we're clear that we acknowledge that. So they will be on the warehouse treatment. The first decision we need to look at, and obviously it's quite a big folio, is the review periods of the alternative repayment arrangements. Your colleague, the previous senator, made a very good point. The review periods may change in the future. It's not a locked-down term in the contracts. So I have been quite open. I've given 5 assurances. We need to be quite open, I believe, in being genuine with customers. The frequency of the review periods, I think, has been a product of the number of people who have been assigned to this. What I also said earlier, verbally, and I didn't have it in my opening statement, is I do not see any customer being reviewed more than annually in terms of the review period, only in the exceptional circumstances. There isn't a specific number in the CCMA code. It does say the word appropriate frequency. We will absolutely consider that as to what's appropriate. And again, I think we would take in when was the last review. I think that would be a reasonable way for us to consider when do we do the actual review itself. But I would also echo what Jeremy has said. While those reviews need to be done in a considerate way, in a sympathetic and constructive way, it's not only in the interests of the servicer and the ultimate beneficial owner. In many cases, it might actually be in the interest of the mortgage holder themselves. I gave a few hypothetical examples. You may have a situation where someone hasn't been reviewed in a couple of years, and unfortunately their circumstances haven't improved, and actually they're in a worse position than they were 2 or 3 years ago. If that is the case, and we go through the review, we want to speak to that person and see if we can do something to help them. So that's how we'll approach the review period. I can't say exactly when it will happen. We will look at all the portfolios. We will work out what's appropriate to keep on 3 years, what's appropriate to do on 2 years.
But in most cases, it's the Pepper that will initiate the review.
Yes, from now on, post 6 months, because remember we're in this interim period, post 6 months they will get, firstly I think as part of the whole, there is a very regulated process in terms of how loans transfer across. I think we had some discussion on that. Part of that is they will get a goodbye letter from PTSB and then they will get a hello letter from Pepper. So one of the points to make is they're not just going to get a letter out of the blue saying, we're Pepper, we'd like to speak to you. The chain of communications will be, hello, we're Pepper, we've now taken on your mortgage. That will be a standalone letter and communication introducing
and you
ourselves.
decide on the interest rate as well?
Yeah, that wouldn't be in the initial letter. All the rates of the loans will pass across as they were on the last day that they're with PTSB. Any communications on interest rates would only be if there's a change in the interest rates, and therefore would only be at some point in the future. So we would have a hello letter that would introduce Pepper, what we do, contact details. Many of these customers outside the review may have day-to-day questions. They may have a question on their tax revenue at source. They may want an additional statement. So clearly we need to do the day-to-day piece also. At a certain point in time, when we decide we want to do the review, by law and by the CCMA code, we need to give that person a month's notice to say that we've reviewed your file and we'd like to schedule a review. And we write to them and give them a month's notice. And that's effectively what that communication would look like. I can't tell you they'll all be in 3 years, they'll all be in 1 year. There's a lot of mortgages in there. We need to work out what's the right thing to do for each of the mortgages. And absolutely, to the previous point, we will be looking at when was the last review to work out again to our regulatory obligations what's appropriate, what do we think is the right thing to do.
Are there any loans in there without warehouse debt?
The loans in the portfolio are so the 6,272 borrower relationships, approximately 4,000 are split in mortgages with a split, so with a warehouse element where there's no capital and interest, and then the others are part capital and interest, where if somebody's paying the interest but they're only paying off part of the capital. While they are structured differently, the net result is the same. There is, when they get to the end of the mortgage, let's say your mortgage matures in 20 years, rather than it being a zero, there is a sum due at the end. And in each case, that could be different.
So, in the case that you're outlining, what happens after the 10 years when there's warehouse debt, everything else is paid off except the warehouse debt? What happens at that stage?
I mean, rather than speculate what will happen then, I think that there's a long time.
It could be in 5 years' time for some people, maybe.
Yeah, so I think what we'd be looking to do is look at every one of the cases on its own merits, and seeing, to my example earlier, we would, let's say it was a case we were doing in the next year, let's say 12 months from now. We would sit down with the customer, look at their situation, go through the assessment I talked about before. We would look at their current state of indebtedness. That's not just their mortgage, so they have other unsecured lending arrangements in place. What is their overall financial situation? What is the household financial situation? Do they have any dependents? Are there any other outgoings that we need to be aware of? And we try and again, if you look at the back of CCMA, all of that's in there in terms of all of the pieces of information we need to gather. We try to get the full picture. And again, we'll take an assessment to say, is the arrangement they're on, has anything changed, positively or negatively, or are things the exact same? I will repeat what I said earlier. If a customer's circumstances have changed, and some will have changed materially, we do think it's the right thing to have a grown-up conversation and say, now might be a great opportunity for you, particularly for someone with a lot of time to run, to actually make a change to this, to actually reduce that
Yes,
debt
but I'm
overhang
saying
at
when
the
you
end.
come to the end, if there's everything is being paid off except the warehouse debt, what happens at that stage? Do you look for the final lump sum to be paid off, or are you going to restructure that for another 10, 20 years?
It depends. We will need to deal with these situations. The good news, I think, is on this portfolio is the vast majority of them. There is a considerable period of time. But we will exactly, as you said, Senator, we will certainly, and in terms of who we do reviews with, we'll probably want to look at those sooner rather than later, because time is important in these things.
And is there interest building up on the warehouse debt?
No, the warehouse debt is completely parked.
It's completely parked?
Yes.
And
again, to reiterate what we said before, that is a term and condition of that arrangement. There is nothing Pepper or anybody else can do to change that. That is the way it is set up, provided the borrower meets the terms of the ARA, continues to engage.
But you can force them, if their circumstances has changed, to reduce the warehouse debt earlier. In the reviews.
In the reviews, we will sit down with them and say that we will look at their overall circumstances and we'll review that with them and work out is there
that
increased
voluntary?
affordability.
Or can you insist that they would reduce the warehouse debt earlier?
If the borrower circumstances have changed materially and there's a clear ability, we will absolutely recommend to the customer. And again,
what actions will you take to make them pay more?
It's usually these processes are, again, they need to be open, they need to be transparent. We need to explain to them all the various options that we've looked at, and we will set out what we think they can do. In an extreme case, if somebody has had a windfall and suddenly can pay it all, and then we sit down with them and they don't want to change their mortgage whatsoever, that is a potential issue, and we need to work through that with them. I don't want to say what we do. Every single circumstance will be different.
But I would think that's where there's a lot of fear for people there, where you will, in the review, whether it's every 12 months or every 2 years or whatever, you will go through their circumstances and you will say you have more of an ability to pay here, you can afford to pay more, so we're putting the pressure on you to pay more. So there's what are you going to do? You'll probably use strong arm tactics to make them.
I wouldn't characterise it as strong arm tactics. The first point is we have an absolute obligation to do this in a very professional way within the strict confines of the code. We are absolutely need to be fair and transparent. We need to treat the customers with due care.
Where can they go, we'll say, if they don't agree with your assessment? Where can they go at that stage? What recourse have they to somebody to adjudicate and say, well, I think the circumstances haven't changed enough? Have they a recourse to?
So this falls under a CCMA process, so they have all the protections of the CCMA process. Like any adjudication of an ARA with Pepper or with anyone else, if they don't agree and feel that the process hasn't been fair and they feel the process hasn't been run the way it should have been, there's a CCMA board that they can appeal to. So that appeal board will be run internally. Ultimately, they have recourse to sending us a complaint, and ultimately they can go to the Ombudsman. All the standard mechanisms to raise a complaint are in place.
You operate for other banks as well and other loans. Is this the way you're going to operate this? Will it be different to the way you're operating other operations at the moment? Again,
every portfolio is different, but I'll repeat what I said, Senator, at the beginning. The actual discretion that we have, particularly with reperforming loans, which are, 98% of the loans are performing against their terms. The discretion we have and the behaviour we have is extremely limited. We have to follow the original loan agreement. We have to follow the ARA agreement. The CCMA codes and the CPC codes are rightfully, because we put consumer protection as quite important in this country, are extremely tight. So there's very few things that we can do that give us a lot of discretion. What I would say is the process we run, I don't expect will be very different to what it would be in PTSB. I think it would be very similar to at another bank and probably very similar to another servicer. All back to my point of they have to operate within those twin tracks of the protections offered by the legal contract underpinning the loan, and the protections offered by the central bank and its consumer protection codes.
What happens if somebody's circumstances, employment circumstances change and they may have to move from one part of the country to another, or they may have to move country or whatever? What happens, you know, if they, clearly they might be able to pay the, do you sell off the property or?
No, absolutely. The first thing we do, we want to find a long-term affordable solution for that customer. It's difficult for me to give a hypothetical answer apart from saying that we want to find a solution for them. As I said in my opening statement, that's what our team do. In the last 6 years we've been here, we've come up with over 4,000 solutions for various customers in difficult situations. We will look at the arrangement. This is a good example of where their circumstances may have changed negatively. We absolutely want to find something, and it could be a change to the IRA, it could be changing the term, it could be an additional interest rate. We will look at all of those various options, all the suite of options we have, to find something that actually works.
Including waiving or getting rid of all of the park debt or the warehouse debt.
As I said at the beginning, there is, and trying to be as open and transparent as possible, there is a mechanism under this arrangement for debt forgiveness in some exceptional circumstances. It is typically not something, and again, to be clear, Pepper as a servicer is no different to the other banks. When we look at these arrangements, we look at we look at a customer, and we look at the sums that are due on that mortgage. And what we try and do is navigate an approach within the codes and within their contracts to find a way to repay that mortgage over a period of time. And we have lots of different solutions and strategies to do that. But that is effectively what we're in business to do, is to work with the customer, understand their individual circumstances, and try and find a solution for them. And as I said, in the last 6 years, we've found, for 4,000 different customers, we've found 4,000 solutions. That's an average of 65 a month. So we work really hard at that.
So the interest rate that's set at the moment when it's been handed over from the PTSB to you, that's the interest rate those people will be paying, other than if interest rates go up or down?
Yes, so on the final day of when the loans move across, we will take them across on the rates that they're on. And clearly, you know, for people who are on the warehouse elements, for the avoidance of doubt, if you're on a warehouse, the warehouse will move across, and that will continue to attract zero interest. We will absolutely replicate how the loans, the last day in PTSB, the first day in Pepper, they will be the same.
Even if the bondholders say, well, we need more money here, what happens if the bondholders say?
It's quite express in the securitization agreement that the SVR policy, so setting of interest rates on the portfolio, is delegated to Pepper. So we need to obviously look at the customer. We look at a range of things like any other bank. We will absolutely keep the customer's best interests in mind. And the main determinant, not the only determinant, but again to be upfront, the main determinant is the ECB rate. If the ECB rate over the next 10, 15, 20 years moves up and down, I can't give a cast iron assurance. There is a likelihood, like every other servicer, like every other bank, that over time, if ECB starts to move, interest rates will start to move. And again, that would be no different, Senator, to what would happen if the loans had stayed where they are in PTSB.
Can I ask Mr. Masling why this is more attractive to the PTSB than just a straight sale to Vulture Fund?
To investment funds, you mean?
Yes. Or to the Vulture, a straight sale to some of the Vulture funds?
We look at different alternatives for each of the NPL portfolios that we have. In this particular case, as we've outlined to each of your colleagues this afternoon, these are treated non-performing loans. They have alternative repayment arrangements in place. Therefore, they have a steady stream of cash, and therefore they are absolutely aligned with the securitisation structure that we've outlined this afternoon. It's horses for courses, depending on the characteristics of the loans, as I said in my opening remarks.
But you had to take a 5% stake in the vehicle, so would it not be better if you were completely separated from it? You get rid of the loans.
We have to take 5% stake.
Yes, I understand that, but if you sold off the loans to a vulture fund, would it not be better for the bank?
Well, we look at different alternatives at any point in time through a series of lenses.
Why have you used this vehicle? Why is this more attractive now than the previous sale that you had?
In no particular order, we think it's a better outcome for our customers, which is the most important decision rule.
But you're finished with those customers.
Can I finish?
Now?
Or first one is it's a better outcome for the customers because they keep their treatments. Secondly, it's the best use of all taxpayers' capital. And thirdly, from our perspective, it enables the NPL ratio to come down instantly from 16% to less than 10%. And when we put all of those reasons in the pot, it feels like a solution that works for all stakeholders.
How do you mean it's the best use of taxpayers' capital?
Well, we would judge it against what a loan sale might give us.
You're going to get either a loan from the bondholders in this case, or you get the money from vulture funds in another case. You're getting in the money. What difference does it make if you're getting in the money? Why would this be more attractive to?
So I have a capital base which the Irish taxpayer gave to us, and my primary duty is to maximise the use of that. To minimise the use of that capital and to get the return back. So at any point in time, I'm making a decision which says, as per my opening remarks, how much capital would we burn if we did a straight loan sale? How much capital would I burn if I retained and provided the loan and then derecognised them? Versus how much capital would I burn if we do a securitisation? That's one of the key decision rules that we apply. Now, in this particular case, we haven't burnt any capital. We've actually got a small capital release, which is a great outcome for the Irish taxpayer. In the other two alternatives, our judgment was that we would have burnt taxpayers' capital, and it's not mine to burn. So, from my perspective, it's a win for the taxpayer. It's an outcome for the customers that enables them to keep their treatments, and it's also an outcome for customers that gives them a servicer who's experienced in Ireland. So, from my perspective, it's the least worst alternative versus repossessing those homes.
Have you any plans to sell any more? Have any more loan sales?
We have an NPL ratio now of less than 10%. It's way off the European average of 3.5%. In 2019, we'll have to look at the different NPL characteristics, and I wouldn't rule anything in and I wouldn't rule anything out.
So what you're saying is that more than likely that there will be more?
No, I didn't say more than likely. I said I wouldn't rule anything in.
Well, you said you're way off the European average of 3%.
There are different ways of skinning a cat, so the securitisation isn't a straight loan sale. So, as I say, I wouldn't rule anything in or I wouldn't rule anything out. We'll continue to work through the portfolio in a way that we think gets the right outcomes for all the stakeholders.
Would it not be better for the bank if they held on to some of those split mortgages that are being fully repaid, we'll say, themselves?
Oh, well, split mortgages stay as NPLs.
Yeah.
They're defined as NPLs.
Yeah.
We have no choice insofar as they are defined as NPLs, so therefore we have to take an action to reduce our NPL ratio. Therefore, take that pool of assets and look for the best outcome for all the stakeholders. The best outcome in this case was Glen Bay.
What about... okay, Chairman, final question. Loans that have very low... mortgages that have very low interest rate, do you plan to sell off some of those, or are they a burden on the bank, or how do you tend to operate with those?
We have no specific plans as at today. Our two big material transactions were Gloss and Glen Bay in 2018. The good news is we also have some what we call natural cures, aka people are returning just through change in circumstances to performing status, so that's good news. Then we'll be left with a stock of non-performing loans, and we need to look at the different alternatives, and as at today I wouldn't want to comment on what they may or may not be.
Okay, Chairman.
Mr. Ryan, with all these customers now transferring over to Pepper to be managed by you, have you written to each one?
Have we?
Written?
No. So as I explained, so just to give, and again for the benefit of any Glen Bay customers, we're in the 6-month transition, up to 6-month transition period. The date isn't set in stone, but it'll be no later than 6 months, where the loans are continuing to be managed on a day-to-day basis by PTSB. The communication protocol will be They
So
will,
after 6 months,
yeah,
you'll be engaged.
before then, PTSB will send a goodbye letter. We will send a hello letter.
What sort of contact details will you give to those customers relative to their new engagement now with Pepper? Will it be a call centre? Will it be someone that's directly employed by Pepper? Will they be named individuals that are, you know, the loan managers, as it were, so they call and they can ask for John or Mary, and that they will be there, you know, on a regular basis?
So the hello letter will give details in terms of how to contact Pepper if there is a specific query or a general query, either pre-transfer or upon transfer. It will give our telephone number for all of these loans will be managed out of our operations centre in Shannon in County Clare. We will have an overall number, and it will go, and that's who people can contact. Given the size of the portfolio, it won't be possible to basically give an individual name.
And how easy will it be to contact? In other words, they phone Pepper, they ask for a particular reference on the loan. Do they get through straight away then to that loan manager or the person that has the details of that loan?
The way it would typically work for us, and I don't think we'd be any different, is they would be given a number. That number would route them through to the team working on that portfolio. So it's not a case of they would be going in and, you know, then being passed around. They wouldn't be routed to somebody with a particular name.
And do you think it will be easy to get through? You're going to ensure that they have an easy access to Pepper?
If we're servicing these customers, you know, we have a responsibility to ensure that the customers can contact someone from Pepper. If we've ever had issues in the past in terms of customers and how they contact Pepper, we take that into account, and it's an area that we would look to improve on.
Will they be able to go and meet with you? Will they be able to go to your offices and meet with individuals?
We can, again, as part of the CCMA, if someone, again, and it's a really important protection that all these customers have, under CCMA, if they want to meet somebody in person, they have that right. We have a field team who can move around the country, and we can make that team available. If we have a customer, the deputy earlier gave a conversation and a description of somebody who's vulnerable. If it's someone where we think it's, and only if that doesn't cause more distress, only if we think it's helpful and constructive, and we think actually a house visit, if we arrange it, would be helpful to the customer, we can arrange that.
And when you have people, those same people employed within Pepper, constantly ringing people in terms of their position with Pepper,
no,
chasing up money,
no, absolutely not.
putting them under pressure?
Again, I'll go back to what we're saying, we're simply not allowed.
I'm just asking.
Yeah.
Yeah, okay.
We have a strong code.
Regulation then, Mr. Masding, this is a question for you, Mr. Ryan. Mr. Masding and yourself, both continually emphasise the fact that you're regulated. You're a regulated entity. So, are you regulated the same as a high street bank?
When it comes to mortgages and how they're serviced, as a retail credit firm and under the various central bank legislation, we have the exact same consumer protection responsibilities under CCMA and particularly CCPC.
But are you regulated to the same extent as a high street bank?
The difference between a high street bank and us is effectively regulations in two parts: prudential, which looks at balance sheet, capital adequacy, and consumer protection. On the consumer protection side, we are regulated in the exact same way.
So you're not regulated to the same extent. You're regulated to the same extent as every other servicing agent in the country.
From a consumer protection point of view, the regulation and the team that we deal with and how we're regulated will be no different to PTSB and any other bank. It will be the exact same codes.
No, sorry, Mr. Masding.
Yeah.
I'm sorry, we have to
No, I'll come back to you, Mr. Masding.
Yeah.
I'll come back to you. As far as the agents are concerned, these agents that are front of house for all of these vulture funds, they're regulated. And I'm just asking, is that the type of regulation you're talking about, or do you have an added piece of regulation that they don't have?
When you say they, Chairman?
The agents, the agents that act for vulture funds, they're regulated agents by the central bank.
Yes, we're a credit servicing firm.
So you're the same as those?
We're a credit.
Nothing extra special about your
No, so to clarify, I think we're a retail credit firm. Effectively, in terms of the Glenbeigh transaction, we're a credit servicing firm. The exact same regulations apply from a consumer protection point of view. There is no difference.
Okay. Pepper, then. You're here since 2012?
Yes.
How many court cases would you be involved in throughout the country, generally, for different funds, in trying to...
That isn't a number. I mean, I prepared in short order for today, and thank you again for inviting me. That's not a number I have to hand, but I can absolutely come back.
But you would have a lot of cases before the courts?
Regrettably...
For different...
Yes, we manage 64,000 loans. We manage 50,000 on the residential side. We manage about 40,000 on the Greece side. Given that we're servicing loans, some of which came out of the crisis, there are distressed loans in our portfolios. Our job is to, as I said, both on the residential servicing and on the commercial real estate servicing, is to find solutions where we can. The reality is, in certain cases, those cases progress through the solutions phase and go into a recovery phase. So there would be.
There would be cases.
Absolutely.
Repossessions then of homes. How many homes with repossession orders do you have?
So if I walk through, let me just make a couple of points on repossessions. Obviously, this is an extremely important topic for Pepper, and I would say in terms of what we do, and if I described what we do for customers, our number one focus is keeping people in their homes. Of all the things we do, that is the most important thing we do. Repossessions, and I know this has been discussed many times in this forum, is an absolute last resort, and I would stress last resort. There's a human dimension to the business we have, and we have a huge sympathy for customers who find themselves in that situation.
How many last resorts do you have?
Sorry, Chairman, could you repeat?
How many last resorts do you have?
If I go through the numbers, and I'm going to use some of the numbers from 2017, if that's helpful, because the 2018 numbers aren't finalised. I think in Ireland there was approximately 730,000.
Sorry?
In Ireland there was 730,000 outstanding mortgages overall. I understand the numbers of repossessions from some previous materials that have gone before the Dáil is around the 1,500 mark in terms of repossessions in the country.
Pepper.
No, across in the whole system. So,
but just for you, though.
I just wanted to give 3 or 4 numbers just to illustrate and give some context. I'm very aware that some Glenbeigh customers will be listening to this or reading it, and I'll make sure the numbers I provide are taken in context. So 730,000 mortgages. In Ireland, 1,500 homes were repossessed, and obviously that is something we would all prefer if it was a smaller number. The orders for possession that Pepper took in 2017 were 51, and the actual orders for repossession that were executed was 18, out of a total number in Ireland of 1,500, roughly. Every one of those is a last resort. One of the reasons we work hard to keep that number down as low as possible is we work extremely hard on mortgage to rent. We are advocates of mortgage to rent. It's an extremely important solution to keep people in their home. It has some requirements, and not everyone can qualify for it. The other last number I'll give, Chairman, is in terms of where we get to a case where we've exhausted all possibilities. And typically, these cases take 5 years. We have 5 years working with these customers to find an alternative solution. Of those cases, approximately 75% have been classified as non-engaging at some point in time. We will work all the way up to the steps of the courthouse for the very small number of cases that go to the court. But at least half of the cases that get to that point, we're dealing with customers who are not engaging.
Will you give us some numbers around all of those? Would you provide the committee with some numbers and some numbers and the detail around those numbers in terms of the length of time you've worked with them? Just to give us a flavour of what you do.
Yeah, I'd be happy to provide. I mean, I think a lot of the numbers are available through the central bank. I've given you.
Yeah, well, just break them down for us relative
yes.
to Pepper and your activities here since 2012. So your use of receivers then, different cohort of customers. You use receivers a lot?
So receivers, just so people, again, receivers typically are not used in the case of
Yeah, I understand.
family homes. They're used for buy-to-let properties or
Yeah.
for commercial real estate. So yes, we use receivers. They're used by servicers and banks.
Yeah, no, I understand. I'm just asking. Just to go back then, the type of information Deputy McGrath referred to earlier on about the information that comes to committee members, they would tell us that from 2012 to 2013 onwards, that it's extremely difficult to get in touch with Pepper. Others would say that Pepper never engaged with them. In terms of receivers, receivers are appointed, no engagement with the receivers. Receivers collect the rent, no evidence that is paid off of the original debt, and that in some cases individuals have, for very small money, debt, very small debt, have lost their business with no recourse to Pepper. They just refuse to engage. And in one instance, I just mention one fund, Pepper Sheldon, is it? Sheldon is another company managed for. Then they discovered that Mars were in it as well. So the point I'm making is that there are examples where customers have attempted to engage with Pepper, have found themselves with apparently associated with one vulture fund and another, a receiver being thrown into the mix, and in spite of the person who had the loan originally, their best efforts, no solution. It gives the impression that the individual has no chance against you, that they feel bullied and harassed in terms of their engagement with you. And I'm only reading from examples of emails that I got, and I've been asked to put that to you today, that there are real cases behind, those allegations. And then they would move on, as Deputy Doherty did, and say that in terms of the transactions, there was no signatures, no approval from the person that had the loan. So obviously you're working on the fine print, being enabled to pass on the loans. So as a result of that, the customer doesn't know where they stand. And I'm just wondering, with those cases existing now and coming to light because of today's hearing, what do you say to that? What's your response to that?
So a couple of points I'd make, Chairman, and thank you for sharing some of those. Firstly, we're here today talking about Glenbeigh and the securitisation, and the reason I bring that up is from a CCMA point of view, there are very strict rules in terms of engagement and how we deal with customers. And the whole area of receivers and the processes that attract to buy-to-let and commercial real estate are quite different. Because of CCMA, how that part of the business is managed is much tighter from a regulatory code point of view. It is absolutely not my position to make any excuses. We're not perfect. And there should not be cases where it is difficult for third parties, such as receivers or customers, to engage with Pepper. It's difficult for me to comment on individual cases. What I would say is some of these cases are quite difficult, where people are in very, very difficult circumstances. And what people describe as, not engagement can be subjective at different times.
Well, okay, let me just be clear about it, because the reason I'm raising it here is because you say how good you are, how customer focused you are, your desire to keep people in their homes. That's your first and foremost, that's your goal. But yet the experience of people that have contacted the committee have been one where there was no negotiations. And on the business side, no negotiations and put in a receiver. No discussion. That's what they're telling us. And as I said, the debt seems to be small. And you know, in one letter, they're asking us, has Pepper an office in Ireland? I haven't been able to engage with them. And I'm putting it to you for clarity, because you're telling us the opposite. You're saying your door is open, you can contact us, we engage, we protect your rights and so on legally. And that doesn't seem to be the case with a lot of people that have written to us. And
So-
that's what concerns me.
Yeah. So, Chairman, I'd reassert what I said for all of our customers that we have residential mortgages for. They will get a hello letter. We are contactable, and we will be working with them.
Okay, you say hello.
Yeah.
Hello, how are you? And the man says back to you, I'm looking under FOI for all of my paperwork. And Pepper said, go to a solicitor. That's in another email. I don't think they're made up. I think that these are from different people. You then press them into court, and the first court case was 2018, and the next hearing is November 2019. And it would seem to me from this that you're playing around with the lives of people. And I want to make sure that these experiences are not going to happen to the new 6,139 loans that you're going to receive.
So, Chairman, I think...
And I want to ask you, finally, on this issue, what assurances can you give those people that are not part of Glenbeigh? They're in your grasp already. What assurances can you? What would you say to them? Who will they contact? Who can they speak to?
So, to answer the question, I need to make a distinction between Glenbeigh, which we're here to discuss today, which is residential mortgage homes and how we deal with those. The majority of the cases you've just mentioned are typically buy-to-lets and commercial real estate. These aren't people in homes. These are investors, some of them small investors, some of them larger investors. There is a different set of rules. There's a different set of codes that surround those. Going through those cases is not necessarily indicative in terms of what we're here to talk about today, which is the Glenbeigh portfolio.
Well, it tells me, Mr. Ryan, that I don't want to have anything to do with you. That's what it tells me. If I was unfortunate enough to end up with Pepper, based on what's being said here, and I'm just giving you the opportunity. I know it's about Glenbeigh,
Yeah.
but this is also about what you're after telling the committee about how you do business. And I want these 6,200 customers, wherever it is, to be reassured by you. And I have to say that what you've said so far has not been reassuring. So I'm giving you the opportunity again, in the light of real cases, being critical of how they were treated by Pepper, to step up and give us the reassurances again, and to maybe reach out to these people and say, look, if you have an issue, contact whatever the number might be.
So for the cases you've mentioned, Chairman, they're individual cases. I'm not aware of all the details. I will absolutely take you up on the offer. Every customer of Pepper, be it a residential mortgage customer or our investor customers, should be able to contact Pepper. And that is absolutely reasonable for a servicer of our size to be able to do that. So I will follow up on that. Can
you give us the details, the contact details where these people might email you?
If I get the details,
instead of emailing me.
If I follow up with you separately, I can get the details on that. But the assurance I would like to give you is that our residential mortgage business, we are that part of the business in terms of how we treat customers and how we contact them is managed very differently. You've read out a few individual cases in terms of customers and how they feel they're treated. With the Chairman's permission, I'd like to give you an example of some feedback we have from our residential mortgage customers that we've received. Because I think that would also help Glenbeigh customers get a feeling of some of the unsolicited feedback we receive as a servicer.
They seem to be then dealing with Jekyll and Hyde. So you have the commercial properties are dealt with one way, and then you have this kind of split personality going on where you're real nice and kind to the others. I just don't get it.
No, I make a point. I take your point. There is no excuse, and from an engagement point of view, all customers, no matter what part of Pepper they're in, should be able to engage and should be able to get answers to their questions.
Okay.
Number one. Number two, we are running a large business. We have 64,000 customers. Like any servicing organisation, like any bank, we will have issues. I said at the beginning, we're not perfect. It's not an excuse, but it means there are areas we need to get better on. The residential mortgage business, it's quite different in terms of how we contact customers. That's the way we're set up. And with the CCMA code, it is extremely prescriptive, and we need to set up an operation that reflects that in terms of how we deal with those customers.
Okay. Can I ask Mr. Masding, how many loans were transferred in this sale where the negotiated position with PTSB is for a period of 3 months or 6 months or 12 months?
Answer that question. As far as I'm concerned, the treatments as they are undertaken between the bank and the customer transfer in full.
So
your question, Chairman.
Okay, you're engaging with the customer. You've reached a conclusion with them as of now that, look, we're going to give you this arrangement here and we're going to review it in 3 months or 6 months or 12 months. How many of those have been transferred to Pepper, or will be transferred to Pepper? Or are all of these loans long-term agreements?
Yeah, they're all long-term treatments.
Every one of them?
Yes.
And by long-term agreements, what do you mean?
Up to 30 years, I think.
Up to the maturity of the mortgage, in effect.
Yeah.
So the lower number then, in terms of the period of time we're talking about, you could have some that will be reviewed in 3 years, some that will be reviewed in 5 years, but there are no short-term.
Oh, sorry.
6 months, 12 months.
I understand your question now. So this is regard to the review period.
Yeah.
So there's a constant review period ongoing. It really depends when the original agreement was made, and in effect it rolls based on that schedule.
So there's nobody that you
So
are transferring
so to be
that
clear,
will find themselves in a very short period of time, a number of months or a year, that will find themselves being contacted by Pepper saying, your time is up now, come in and we want to talk to you about the arrangement that you have.
It's a question for Pepper more so, but
No, it's a question for you. How many of these loans have you negotiated whereby when they're transferred to Pepper, they can review negatively or whatever way, positively, I doubt it, these loans?
1 second. I'll have to check that, because there's a review period that travels every month.
Well, as you check that, can I suggest a comfort break? I'm told for 5 minutes, 10 minutes
Okay.
for everyone. If I
Yes.
can hear us do it.
Yeah, sure.
Is that okay?
Thank you.
Members, 10 minutes. Suspend. Senator.
Just a couple of questions. A lot of points have been covered, and again to welcome you and to thank you for at least turning up, which a lot of other credit servicing firms haven't. So to be fair, thank you for that. In terms of the 400 million or thereabouts, the difference between the gross book value and the net book value of the loans, I think it was Mr. Crowley, you said it was the figure you used was basically the net book value. Yes. Pepper can still pursue, or Pepper on behalf of Glenbeigh, I presume, can pursue the full 1.3 billion, and presumably will pursue the 1.3 billion, and they effectively then will be the beneficiaries of that gain if it happens. Is that correct?
That is correct. That's legally correct, yes.
Okay.
Just to, if I could clarify, Senator, Pepper won't, I mean, in terms of, Glenbeigh Securities.
Yeah, I said that. I said Pepper on behalf of Glenbeigh.
Yeah.
Will be going out and pursuing the full extent of the monetary amounts that are outstanding.
Yeah, if I could just clarify with the pursuing, again, I'll go back to all of the loans as they are restructured will stay restructured as they are. They will be reviewed regularly. The way it's structured is there is a significant sum of money that's due at the end of each mortgage. So not obviously at a singular date as each mortgage comes to the end.
And is there a kind of this warehousing concept? Is that in almost every single one of these particular loans that were transferred?
I mean, I can answer that. It's approximately 4,000 are warehoused, and about 2,000 have a different treatment where there is interest being paid on the full amount, but only a part capital is being paid. The net effect for a customer is the same, in that there is money due once they come to the end of the arrangement. There still will be a sum due.
So in all of these 6,000, whatever it is, cases, there's a significant lump sum payment due at the end of the term.
Yes.
10, 20, 30 years, whenever it happens to be.
Yes. The terms warehouse and bullet are interchangeable.
Okay. And what is likely to happen, I suppose it's a question for Pepper, because PTSB won't be involved at this stage. What are your likely suite of options, looking at people whose arrangement is coming to an end? There's a significant lump sum outstanding. It's likely, I would imagine, that a lot of people won't have that lump sum. Do you restructure again? Do you examine it? Or do you just say, right, you're not able to pay it, we're repossessing the house? Or what is the likely outcome?
So I think, that process is currently being managed by PTSB. PTSB are currently going through the reviews, some on a triannual basis, some more often. When the portfolio moves across to Pepper, that will then move on to us. I mean, I think, firstly, every circumstance will be different. In terms of what happens at the end, that will be part of the review period. So each time we do a review, it'll be, has anything changed? And let's take an example of somebody whose mortgage is due in 20 years' time. As you said at the beginning, and I think we said a number of times, it is in most people's best interest not to have no plan for what happens at the end. And I think when you're looking at restructuring arrangements, time is a critical factor. So if there is plenty of time, and it's not the same for all customers, but thankfully for the majority there is time, we would look to engage with them in the first review and see is there additional affordability. We can look at all the various ARAs. Our ARA suite is the same, the alternative repayment arrangements, in terms of recapitalisation, term extensions, all those things are available. But I think the main piece is there an ability, has the affordability changed, have the circumstances changed? The easiest way for a customer to address it is only if it's affordable, if it's a sustainable arrangement and it's in their best interests, is actually to pay more off each month. That's the most basic arrangement. That can happen if the circumstances change, and as I said, if they don't change, then that's off the table and we continue on as we are, and we look at it again the next year or in 2 years' time. That's effectively how we'll approach it. Every case will be different. It's difficult to give a broad answer well into the future as to what will happen at the end.
And do you have an idea of the profile of these 6,000, whatever the figure is, in terms of how many are going to arrive at this warehouse payment in the next 5 years, 10 years, 15 years, 20 years? Do we know where we're kicking the can down the road, but I'm just trying to work out how far down the road it's going?
So the vast majority are, so again, 86% are 10 years or more, 50%, just under 50%, about 49% are 20 years or more. There will be a couple, I don't have the exact number, that will be shorter dated, that will be in the next couple of years that we will need to look at.
Okay, and if somebody, say it's 2 years away, and at the moment they're meeting the terms of the restructure, but there's a significant payment, and typically do we have an idea of as how much gets warehoused? Is it of the original loan, if it's 10,000 or say it's 100,000, have you been warehousing 70 or 80,000 or warehousing 10 or 20,000? Do you want to take that?
There's no one answer. The warehouses have been up to 80%.
Okay.
So
that's a very significant amount that they're going to arrive at.
I mean, as I was very taken with what Cormac said around Pepper's desire to keep people out of repossession, and that is why PTSB is, in inverted commas, the market leader in split mortgages, because the alternative was repossessions, and so therefore some of the warehouses are quite long. Secondly, to reiterate what Cormac said, the vast majority of these warehouses are out on a 10-year plus horizon, so that at least gives or was giving PTSB and now Pepper time to work with customers to try and find the right solution. And then I think just in the spirit of being transparent, and I know you would understand this, but for the record, those capital sums are due. I mean, they are part of the borrowing contract with PTSB, and they are due. And so the benefit, I think, of a split mortgage having a long duration is that at least we can work with customers. We could work with customers, and our Pepper could work to try and find and work our way through them.
And typically, those warehousing, I mean, they're still charged interest on the loan.
Let's go through the two treatments. So the first one is called part capital and full interest with a bullet. So in the payment, they're paying the full interest amount, they're paying a full capital amount, and therefore, because they're paying a part capital amount, because they're only paying a part capital amount, it goes into the bullet. Does that make sense?
What is it, the bullet?
The warehouse, the final repayment.
Probably not the best phrase to use, but anyway.
No, as I said, I was thinking maybe I should speak English, actually. The final repayment. Sorry, I apologise. The second one then being a split mortgage.
So the total, I'm just saying, the capital that gets warehoused is still, there's interest being charged on it?
No, so on the part capital and interest treatment, yes. On the split mortgage for the residential homes, no.
So you're giving interest forbearance on the bit that's being warehoused?
Yeah, the bank is basically funding the warehouse. Yeah.
And will that continue with Pepper?
Yes, I mean, again, the arrangement, the contract, the original contract.
I just think it's important for people who are looking in or who are conscious that, I don't think we can say it enough that you're saying the terms and conditions are not changing.
I agree, Senator. It's very important to say over and over again, the arrangements and the contract stays the same.
And I know certain financial institutions were very unwilling to do debt forgiveness in the past. Had PTSB, were you willing to do some level of write down to manage it, or was it all a case of...
PTSB doesn't do debt forgiveness.
You didn't?
We don't do debt forgiveness.
You don't do debt forgiveness. And would that be the same with Peppers historically?
So I think if we talk about Glenbeigh going forward, I mentioned earlier there is a mechanic in the prospectus for eligible debt forgiveness in very exceptional circumstances. That might be in a vulnerable situation, it might be part of a personal insolvency. It is something where, again, we would look at every case individually, and if there's an absolutely exceptional case, we can make the recommendation. There is, because we have no economic interest in the portfolio, the underlying beneficial owner ultimately has to make Glenbeigh Securities whole. So we would do the analysis, we would determine that it's an exceptional situation, and we would put forward the recommendation. But there is a mechanic where ultimately, to keep it in simple terms, the beneficial owner would need to say they agree and would need to agree to that sum.
And then just to tackle, and then just in concluding, in terms of the say somebody bullet boards or their end of their arrangement is 3 years' time, there's a substantial amount of money, 30, 40, 60% of the original has been warehoused. What happens in 3 years' time? Do you offer them another restructuring of extending it out, or is it a case of, look, you're not able to stump up the lump sum and we want to repossess the house and out you go, or what's the likely...
So, I'll repeat what I said earlier, Senator. We are not in the business of repossessing homes. They are a last resort. We're in the business of finding solutions. We've found over 4,000 solutions in the last 6 years for customers in various different situations. That's where we'd focus. Every situation will be slightly different as to what's available. Our focus will be on finding a restructuring arrangement that works for the customer, that absolutely keeps them in their home and allows that debt to eventually be paid.
And the customers you have had up to now since 2012, you're working on behalf of various other people like Glenbeigh, is that it?
Yes, so our clients are a mixture of banks, they're a mixture of investment funds and a mixture of institutional funds on the residential mortgage side.
Okay, thank you. Thank you, Chairman.
Thanks. Just to take up on one or two earlier points. First of all, in terms of talking to the committee today, you obviously felt restricted at various points by the confidentiality agreement that exists in relation to Glenbeigh. And so what I wanted to ask you is, given that you both have stressed the fact that you're regulated entities, and regulated by the Central Bank of Ireland ultimately. Would you agree?
Yes, well,
Yeah,
Pepper is
you're
absolutely a
regulated
regulated entity. Yes.
by the Central Bank.
Yes.
Yeah. So in that context then, given that so much information here was, if you like, off the pitch because of the confidentiality agreements, is the Central Bank privy to the confidentiality agreements as the regulator of yourselves in the PTSB, Mr Masding, or yourselves in Pepper, Mr Ryan, or indeed, is there any oversight, as far as you're aware, by any regulator in Ireland in respect of Glenveigh?
We haven't signed a confidentiality agreement, and that's all I'm prepared to say. I'm not. I'm not going to
So you're
provide
not
any further
prepared to
information.
say if the Central Bank has had any oversight? Like they are the regulator. I'm just trying to establish, because I think it's an important legal point. These confidentiality agreements, obviously very important. They're the core of the commercial transaction that involved the homes of 6,000 people. And I think the committee, notwithstanding you've come in and you've been quite cooperative, I think on behalf of the people who are extremely anxious about this, I just want to know.
I think I misunderstood your question. So let's go right back to the start, and then I'll take you through the journey. So I won't repeat the MPL story. You know where we're at. My duty as the Chief Executive, the governing objective of a Chief Executive is to manage the capital of the bank, which the taxpayer gave us. But obviously, in terms of that governing objective, there are also other tests that I have to pass, one of which is right customer outcomes. So that's how I think. So as we constructed the deal, we have a series of stakeholders that we have to consult with. In Eamon and Mai's case, those stakeholders include the board of the bank. They include the Department of Finance. They include the prudential side of our banking regulator, and they include the conduct side of the banking regulator. And I can assure the committee that we followed the right protocols in terms of dialogues with each of those stakeholders, which led to us completing the transaction last week.
So are you implying, if I may ask you, Mr Masding, therefore, that the Minister for Finance, Department of Finance, as a significant shareholder, are you implying that the Minister is in fact privy to the confidentiality agreements?
To the best of my knowledge, the Minister for Finance is not privy to the name of the investor, because I am bound by a non-disclosure agreement.
Okay. And could I ask, again, you made a lot of reference, understandably, as the operational structure you're operating under, to the confidentiality agreements, but you also made a very important stress on the fact that you're regulated. So in terms of the references to the confidentiality agreement, has the regulator sight of those confidentiality agreements?
So the regulator, the Central Bank of Ireland, who we work very closely with, and we did notify for deals like this. I don't think we have a strict requirement, but we do notify the regulator of significant transactions or contracts we're about to enter into. The Central Bank haven't sought the details of the non-disclosure arrangement that we have in place, nor did I offer, or nor did it come up in any conversation.
So were the Central Bank to require sight of the confidentiality agreements, would you be agreeable, or would your legal position, do you think, permit you to disclose those to the Central Bank regulators?
To answer the question, we have an extremely open relationship with the Central Bank. I can't recall to date, while I've been in the role, where they've made a request that I haven't met. On this particular case, given it has some legal implications, I need to consult with my legal team. I'm happy to come back with the technical legal answer, but it's not something I can answer with right now. But in spirit, we try to be as open as we possibly can with the regulator.
And can I just ask you one other point of explanation? In the summary, the the package of loans was originally valued at par at about 1.3 billion. The PTSB.
So that was the amount due from borrowers, the total amount due from borrowers, yes?
Yeah. Well, another way, could that be a layman's way of putting it, or a laywoman's way of putting it, that the value of the whole bundle was, as it were, in terms of your book debt, 1.3 billion?
Yes,
perhaps a layman's way of putting it is PTSB's customers owed the bank 1.3 billion
yeah.
euros.
Now, you then, in terms of passing it over to Glenveigh and then to Pepper, the value was 890 million. Now, just explain to me, I mean, one way of reading that is that there's been a transfer at a valuation loss, book loss, I don't know what you want to call it. It's a while since I practiced accountancy. But it seems to me that's a book loss or a discount or whatever you want to call it of over 30%. Like, I think that's a significant, very generous deal for Glenveigh. I mean, it gives them, I mean, maybe that's the value of a lot of the warehouse loans, the warehouse elements. I don't understand. But would you agree that that's the way a lot of people would look at it? And also, when that goes in to the PTSB books, if I'm not mistaken, that then creates a tax loss, because it's a write-down of a debt, and specific bad debts are always allowable, in my experience of tax, as write-downs.
So I'll allow Eamon to take the second question. The first question, in terms of the deal, I would not agree with the phrase generous, because we had provisions against those loans. And actually, if you read the statement we made to both the stock exchange and then to the media, having done all the calculations, actually the Irish taxpayer, the capital base of the Irish taxpayer actually improved, or the capital ratios improved.
No, I understand the point about
so
capital.
it's not a generous deal, because actually there was capital accretion. And in terms of the tax,
I understand your point about the NPL situation, but in the documentation, by the way, from the European Central Bank, reference is made to setting up basically a platform to sell more easily NPL loans. So what I'm interested in, and I think what a lot of the people who've been in contact with us are really afraid about, is that these are going to be traded on and flipped. You know, maybe not instantly, but given the long duration of a lot of the loans, that they may be flipped fairly often. And I mean, you'll have long departed the scene then. The Pepper are only a service agent, so who is there to protect, in terms of the different codes, the holders of the different mortgages? The mortgage holders.
I think it's just a point of principle that we just need to place on the record, because it's obviously impossible for us to predict the future. The point of principle is, regardless of ownership, the consumer protection codes and the contractual protections travel with the loan. I don't know whether you'd agree with that, but I think that's the point of principle.
I'd repeat the same point. So I think from an ownership point of view, it's difficult to predict what will happen. It is a long-term investment in vehicle. I think as part of the prospectus, it does say some of the investors and the bondholders may change over time, but ultimately the vehicle is expected to, it has long-term assets, it's expected to be a long-term vehicle.
But do you agree, and I appreciate you're a service agent as it were, do you agree that in fact the transfer was done on very favourable terms to Glenveigh, because it had a value, whatever way we want to describe that value, as 1.3. It actually came in at 890. In fact, in the original documents, I think PTSB had suggested they were going to get a bit more. They were going to get 910 million. So, you know, it's a very sharp transaction.
No. Sorry, I just need to place a couple of things on the record. So if you go back maybe 12, 18 months. And when the all European banks started to think about their NPL ratios. If you look at PTSB in a specific case, the market was saying, so the brokers were saying, the people who write about permanent TSB, and Eamon will correct me if I'm wrong, but many of the notes at the time that they were writing were predicting that permanent TSB, in order to reduce its NPL ratio, would probably have to burn the taxpayers' capital of somewhere between 250 and 500 million euros. Is that correct?
That's correct.
That's correct. So when you look at the sum, and Eamon will have all the numbers better than I do, but when you look at the sum of Gloss and Glenbeigh, if you compare, let's take the outer extreme of 500 million, the actual is how much for?
It's in the region of 20 to 30 million. So these are educated analysts who are looking at the valuation of our book, and we're putting their valuation on it, and said for the purposes of exiting the Gloss and Glenbeigh portfolios, the bank would lose in the region that Jeremy said. In fact, we have lost in the region of 20 to 30 million in both sales. So that would not reflect a giveaway in any regard. There's no doubt that if you take Glenbeigh, there is a discount over the 1.3 billion that's owed by the borrowers, but that will not be paid for 20 years, 10, 20, possibly up to 30 years. And anyone buying that book would have to fund the cost. They'd have to incur an interest cost in funding it, and that's part of the discount that they would build in.
Why is that important? Because obviously my primary duty, as I've said in all my previous appearances here, is to do my damnedest to repay the net funds which the taxpayer put into permanent TSB. And if the market analysts make a judgment that was 500 million and it actually turns out to be 20 to 30 million, by definition, the value of the entity is a lot higher. And so I wouldn't agree with your statement that it was a generous deal. I think it was the right deal for all Irish taxpayers.
Thank you.
Are you okay with that?
Thank you.
Deputy Fitzmaurice.
Thanks very much, Mr. Chairman. Just a few quick ones first, Mr. Masding.
Of course, Deputy.
Does the bank at any stage, obviously 3 or 4 months ago you decided that you were doing this, or maybe longer, is there at any stage when you're deciding to take 66%, because it's maybe 66%, that you write out to the customers and say, if you have family or friends or anybody, I'm just looking at a mortgage that might be 300,000 and to be 200,000, then that they would be offered to the ordinary people rather than making basically vulture funds up?
Sorry, run that past me again. What am I being asked to do?
Customers of the bank,
yes,
that had the deals with you, was there at any stage that you contemplated writing to those people when you were prepared to take 60% of the overall debt, to offer them that if they had anybody belonging to them or were in any position, that they may be able to get their hands on that type of money in full and final settlement? Was that ever contemplated by the bank?
I wouldn't do that for 2 reasons. The first reason being that it creates a risk that actually there's a knock-on effect for those who might see that the bank is doing deals, and that's not how it works. And then secondly, I wouldn't do it because my duty is to all Irish taxpayers to get the best possible deal that I can, and a deal which, like Glenbeigh, is a better outcome than hypothetical individual deals with customers. They're the 2 reasons why I wouldn't do it.
So it's a better outcome to maybe people lose their house down the road, or maybe family or somebody be able to come in and help them when they'll be going for the 33% more. You think that's a better outcome, do you?
My duty is to get the best outcome for all Irish taxpayers, and I'm confident that I've achieved that.
From what I've heard earlier on, you have stated that the Minister for Finance and the Department of Finance gave you the go-ahead to do this. Is that correct?
No, I didn't say that. Under the framework agreement, we are obliged to consult with the Minister for Finance. If your question
was there any objection from the Minister for Finance?
We consulted with the Minister for Finance. The deal has proceeded. That's my conversations with the Minister for Finance are. I can't comment on his behalf. We consulted as per the framework.
I'm asking you a very simple question. Was there any objection from the Minister for Finance or the Department of Finance with the loans being sold on?
I only have to consult. I consulted, and the Minister for Finance was content that the transaction proceeded.
Can you tell me, in the loans at the moment, we would have people that would have entered into an agreement with you that they may have 6 payments before they get their overall decision on the length of time or the agreement that will be put in place. How does that stand at the moment? Who's going to make the decision on that? Is it Mr. Ryan or is it your bank? That people that in June or July were told that they pay 6 payments and then they'll get a deal for whatever length of time, and Christmas is coming, which of December will be their last month, so you'll be in January, you'll be getting your lovely letter from me telling you of the deal going into the future. Who's making the decision now on those people?
Yes, sir.
Those customers are not included in the transaction. The only customers that are included have actual AORAs in place.
Right. And in the line of selling houses, because I'm actually selling a house with a distressed mortgage at the moment, and this is in your previous one, to get agreement at the end, after you announcing the sale of them, we've been told by your bank that they have to go and get agreement from the buyer of that, from the buyer of the loan. Is that correct?
You're talking about a Project Gloss transaction.
Yeah.
To the best of my knowledge, we're here to talk about Project Glenveagh.
Well, it's a simple question. It will work the same with this in 6 months' time.
I'm not here to talk about Project Gloss.
You're right.
I'm not here to talk about Project Gloss. I'm here to talk about Project Glenveagh. That was the rule.
If you were negotiating with you at the moment for a loan to sell that somebody was selling their house, and as it takes a few months, in a few months' time, before this has completely gone through, who's going making the decisions? Is there an obligation on ye, before ye take the price that's offered for the house, that you have to contact Mr. Ryan? We'll work on this one if you don't want to work on the other one.
The answer is yes. We would consult with Pepper with regard to that.
So it's them that will be making the final decision.
We would consult. We would be dealing.
Yeah, this word consult. We're consulting with everyone. I'm asking who's making the decision.
Well, the situation in this regard, this portfolio is unlike Gloss, because these are customers who actually are performing to terms that are already agreed.
Yes.
In Gloss. There's obviously more difficult cases that we would have discussed to this committee before. So the situation is that the beneficial interest of these loans is now Glenveagh's, in Glenveagh's name. Pepper are the master servicer in that regard. We're the sub-servicer for the next 6 months. So we would consult with Pepper in that regard.
Right. To Mr. Ryan, where there's agreements to be reviewed in 3 years, if what you were saying to me, or maybe, and just to clarify it, if the incomes and the SFSs are the same, you're willing to continue those agreements on until the loan is finished?
Yeah, exactly. For the question, I would clarify, it's not that we're willing, we're obliged to continue them on, and per my statement earlier, we will honour the arrangements if there is no change in circumstance.
And can you just, because Deputy McGuinness and myself be fairly used to dealing with different banks and vulture funds, and we are in situations, you're familiar with Capita and the different names they have, and Promontory and all those, and just explain this to me. When some public rep goes to represent somebody that may be in financial difficulty, and they talk to ye, can you give me the chain? Are ye the middleman like Capita, or there's talk about Goldman Sachs? Can you tell me the different sort of pieces of the jigsaw that's involved in all of this?
So I think it's important to look at all those arrangements. It's difficult to generalise, but let's talk about Glenbeigh and how that will work.
Yeah,
so if there's an associated third party, if there's an ATP third party, and if you or one of your colleagues is representing a borrower or consumer within Glenbeigh, you would deal with Pepper. If it was around, let's bring it to an example, if it was around a restructuring arrangement in terms of a view in terms of what the outcome is, a view that their circumstances have changed or haven't changed, you would ultimately deal with Pepper.
You will deal with Pepper?
Yes.
Right. In the line of somebody, and we are getting letters at the moment, mortgage to rent, right? If you're eligible for social housing, obviously you're eligible for mortgage to rent in a distressed scenario. And councils at the moment in one county, and we are waiting on others, are writing back, even though you're eligible for mortgage to rent, you're eligible for social housing, you may be in a house that is under distressed or being repossessed, saying that it may be too rural. What medicine have ye for those people, or will ye do the mortgage to rent?
So mortgage to rent, firstly, I think as I've said earlier, is an excellent solution for people. We are advocates of it as a solution because we're focused on keeping people in their homes. And in many
who's
cases,
going to pay you? Did you hear what I said there about the councils?
Yeah.
The councils have written back to the housing body and said, we think that this is too rural. So obviously they don't want to cough up of even though they're eligible for social housing. So what will your medicine be then?
On mortgage to rent, so the mortgage to rent scheme as it currently operates, as people know, is relatively complex in terms of who's eligible, who's not eligible. If we find a customer who's worked, and typically they've gone through many years and we've tried to restructure them, or PTSB will have tried to restructure them, they're then in a legal process and then mortgage to rent. If we can make it work, we'll try and make it work. But there are some rules. Certain customers will fall outside eligibility. That will not be within the control.
But if you're I've said already that you're eligible, and from my understanding, the council that pays the difference of between the rent and the rest, the total. And if the councils are saying it's too rural, what will your solution to that be?
I think in that instance, what would happen is that you would move from utilising an MTR solution to one of our other suite of solutions for that type of borrower. That's a structural feature of the MTR eligibility.
What's the other ones?
Well, we've an entire suite of 14 ARAs that we can make available or already have, which are in line with PTSBs also.
Yeah, that's fine, but what I am trying to establish is, are you going to take the councils at the moment, it's €10 for the first 100 and €20 after that. And for the sake of argument, we're on €500, which is €90 a week, €360 a month. And if the mortgage was 700, and that the councils are saying to ye, this is too rural, who pays the difference? And the eligible for social housing?
So, Deputy, I think it's very hard. We would look at all situations. If we could make a mortgage to rent case work, we would make it work. I would repeat what I said at the beginning. We have done more mortgage to rent solutions than any other provider in Ireland. We're very much engaged with all of the housing bodies and with the 2 mortgage to rent bodies that exist in Ireland. If a customer gets to the point where mortgage to rent is the last solution apart from going down a loss of ownership through that voluntary sale, AVS or repossession, we will explore all options to make that happen. What I can't give you is a cast iron assurance that in that situation it's a yes. My team would need to get into the detail. But I would remind you that we have done more than anybody else, and we actually think it's a great solution where we can make it work.
For people in what we call Middle Ireland that are in difficulty with their mortgages, what will your medicine be for those people?
The first step, as I've said earlier, is if we just describe the Glenbeigh portfolio. The Glenbeigh portfolio, these are all customers who at some point in time went through distress on their mortgage and their mortgage was in arrears. And I've recognised that already, approximately 6,000 borrowers. All of those borrowers are now under the protection of CCMA they're under alternative repayment arrangements. And my understanding, and I stand to be corrected, is well over 95, 98% are all performing. They're performing to their new arrangements. I'm not sure in terms of the treatment, they already have a treatment. They already have been engaged by a team trying to find a solution to the situation they're in. The issue is, while they're now back, they're affordable, hopefully some of the distress of the situation they've been in has been taken away. There is, at some point in the future, for 86%, it's 10 years plus in the future, a lump sum that is available, that is due to be paid at the end. We would engage with all those customers when we have review periods, work with them sympathetically, constructively, positively, work through all of our different arrangements to see, is there something that works for the borrower and is realistic. It has to be realistic and has to be fair and it has to be in their best interests, that might help them chip away to reduce that sum at the end.
You spoke about 4,000 houses and 2,000 houses, is that correct?
So 4,000, so when I said there's 6,272 borrower relationships,
4,000
approximately 4,000 are warehoused. And 4,000.
Right, what's the percentage on average for those 4,000 that's warehoused?
You say the percentage?
Percentage of warehousing.
That's not a number I have.
The average across the whole portfolio is about 50%.
Right. Thank you.
Okay. Just coming to the end now, so we'll be over here by 6 o'clock. For those of you that might be concerned. Just very quickly, with PTSB, did you make every effort to go down the mortgage to rent model or solution to any of these before they went over, or as they're going over?
Yes, so with regard to mortgage to rent, in our gloss portfolio, we excluded 700 accounts that we believed were eligible for mortgage to rent.
Yeah.
We have engaged in 984 accounts, and there's about 385 of those are live at this moment.
Okay, I think I asked you this before, Mr. Masding, or you, Mr. Corey, that you use the iCare model or similar.
We have a couple of providers.
Sorry,
We have
you have a couple of clients.
There's a few
use
providers, yes.
You use those, so you work on them continuously.
Yes.
And in terms of Pepper and the, you know, you get a standard financial statement from the individuals. Is that worked in exactly the same way as PTSB would have worked it?
So the SFF statements, in terms of all of the information you gather, again, is actually prescribed under CCMA at the very back of the code. It's there. It is, you know, I would regard it as materially standardised. We haven't done a line-by-line check, but from what I understand, they should materially come up with the same outcome.
Same thing. So in your review,
I'm not aware of any major difference in terms of how they're both codified and approached.
And in terms of the insolvency route then, to go back to PTSB, like a lot of these splits, 50% is the average split across that loan sale. That was very big from the beginning, wasn't it? Or did that just emerge over renegotiation through the years?
I suppose two or 3 points of principle. So since 2013, we set out to the best of our ability to keep people in their homes and to find the right treatment. And so that'd be the first point of principle. The second point of principle I would make would be for both Gloss and Glen Bay, there's an outer perimeter of mortgages, and we go through a process to try and get to the cleanest portfolio. So as Eamon said, through the course of this year in both transactions, using mortgage to rent as an example, we have taken customers who are out of that. We've taken customers out of that original perimeter and put them in a mortgage to rent solution. The same thing would apply with bankruptcy and insolvency.
And what do you think of the restructuring where parts of the loan were, you know, it was warehoused? Did that give a false sense of, I suppose, hope to the customers who believed that they were now in this new arrangement and they will be staying with your bank?
I think I would say that back in 2013 we were trying to get a balance right between the following. Number one, we are acutely conscious of the 70, at that time 100% ownership, now 75% ownership. We're just acutely conscious that it's all Irish taxpayers' capital. So on the one hand, we had to reinforce to those customers, and we continue to reinforce, and I'm sure Pepper will as well, that those amounts are due payable. However, we also had to have sympathy with affordability. And so, in many ways, the Irish taxpayer, I suppose, if you look at it like that, they have funded those warehouses because we don't receive any interest on them. So that was the balance we were trying to get between doing something that felt like the right customer outcome, but at the same time trying to balance that with our duty to all Irish taxpayers in terms of the capital that is due.
And again, in terms of the loan, those that took out loans and now are going to Pepper, have you done any analysis of the age profile of the individuals concerned?
Not the age profile that I'm aware of. Obviously, we've done analysis of time to expiry of the mortgage.
You have no figures on that analysis, no?
Not with us, Deputy Chairman, sorry.
And to go back to Pepper, I'm just clarifying a few points that were made earlier on. The solutions then and the code of conduct. You said earlier on you provide the full suite of solutions. Isn't that correct?
Yes.
And there's no difference then between you and PTSB in that regard?
There's no material difference.
Okay.
We did actually compare prior to the transaction exactly what we did and they did. There's no material difference.
Okay. Then, Mr. Crowley, you said earlier on that you were I'm just seeing now, PTSB originated the structure. I think you were answering a question in relation to Glen Bay.
Yes.
What did you mean by that?
Well, we are the creator of the structure.
Okay.
On day one.
Sorry?
On the very first day.
Okay. So does that mean that you registered Glen Bay? Or does that mean that you created Glen Bay and offered it to somebody else?
No, we registered Glen Bay.
And who appointed the directors then to Glen Bay?
That was all part of the structure. Bank of America.
No, was it you or was it somebody else?
Well, appointed through Bank of America. They are the Bank of New York, sorry, not Bank of America.
Yeah.
Apologies.
But why them? Did you negotiate with them?
They run many structures of this nature. Indeed, they're involved in our Fastnet structures. We have a Fastnet securitization vehicle that we use ourselves, and they are part of that. They're a party that we've used in the past.
So the way it worked, I'm just trying to get into how it works. So you would have gone to them, or they would have been aware that you were creating this and expressed an interest in it?
They are very used to the structures we've created in the past.
Yeah, but did you go to them, is what I'm asking?
In effect, yes,
Yeah,
yes,
okay.
yes.
So we have Pepper managing now, and we get a clear picture of how they intend to manage and so on. Then they're responsible to Glen Bay, right? Glen Bay and Pepper will operate through a committee on interest rates and the role in terms of your consultative role on that committee.
Yeah.
But Glen Bay pay you. Is that right? They're the paymaster there.
Our master servicing arrangement
Is with Glen Bay.
is with Glen Bay Securities. Yeah.
But yeah, so they pay.
Yes.
So how many are on that committee then? How many would be on it typically on a committee like that?
It's difficult to say typically because I think, like a lot of these transactions, it's quite bespoke. So the committee, the operating committee, is effectively the main beneficial owner. So that could be one or more people. We haven't formed it yet.
What do you think? Just to give me a sense of what it means.
It will effectively be a forum.
Would there be 2 people? Would there be 10 people?
I think it'd be more. It's going more likely to be 2
Just
people.
an idea.
Yeah,
Sorry?
it's going to be more. So we haven't formed it yet, but our expectation would be 2 to 3. 2 people. It would be the servicer and the main beneficial owner.
Yeah, it's just that when you say committee, there's a different
It's slightly,
understanding.
yes.
So, as far as you're concerned, it's a tight 2-3-man ship.
Yes, very much so.
So then they go back to Glenbeigh then again. You mentioned then, again, just to understand the structure, the Bank of New York is the trustee for Glenbeigh.
Yeah, so just turn on page 1, the actual very first page of the prospectus, which is publicly available. It details the structure quite clearly with regard to and it's a standard securitization type structure, and it shows the parts that all the various parties to the transaction play in that regard.
Yeah, well, but just to answer the question, so
yes,
they're a trustee. Is that right?
The trustee.
The trustee is the Bank of New York, you said.
Sorry, the bank, BNY Mellon Corporate Trustee Services are the trustee.
Who?
It's not Bank of New York, BNY Mellon. So it's Bank of New York Mellon, apologies, yes. So
It's not the Bank of New York.
They are the trustee, yes.
Who is?
A company, BNY Mellon Corporate Trustee Services Limited, which is, again, clearly outlined in this structure.
Yeah, no, I understand. I'm only trying to correct what you said earlier on, which you said earlier on. That was
It's
the Bank of New York.
Yeah, but Bank of New York, BNY Mellon is a Bank of New York company.
Yeah,
it is
okay,
Bank of
so
New
it's
York.
the Bank of New York company?
Yes,
or a company
a subsidiary,
under the Bank of New York?
a trust services subsidiary.
Right, so who then appointed the 2 directors to Glenbeigh? They're just nominated people, I presume.
Correct.
Are they Irish people or?
Yeah, as I understand they are, yes.
Yeah, so that's a normal thing. Glenbeigh is registered.
That's
2 directors
correct.
appointed.
That would be a typical for these structures, yes.
Then they go back, they'll link back into that company name that you spoke about, which is under the umbrella of the Bank of New York.
Correct.
Okay. So, as a trustee, that bank, or that trustee, that trust, would own Glenbeigh.
Glenbeigh would be what was described as an orphan vehicle, but it would have a very significant influence in ensuring that Glenbeigh operates properly. It would be the trustee to ensure that everything operates properly.
Well, for an orphan vehicle, it's going to command a fair deal of economic benefit, isn't it?
Well, it ensures that the securitization vehicle is operating, has the proper ingredients by way of how the cash moves, bank accounts.
So therefore,
financial
back
statements.
up along this chain, back into, we'll call it the Bank of New York. They then can sell their papers, isn't that right?
Primarily in the securitization vehicle, it's the note holders who actually...
the note holders are within the Bank of New York.
No, the note holders are...
The trustee, rather.
The bonds that are issued, and the people who own the bonds that are issued, they are key parties to the vehicle.
They're the trustee.
No, they're not the trustee.
Right, well then who... The Bank of New York is the trustee.
Yes.
Maybe I'll try and help.
So what is the function of the Bank of New York?
Maybe I'll try and help you.
Yeah.
So the SPV is a limited company, obviously. Glenbeigh is a limited company, and therefore it will have minimum regulatory obligations. And so as part of those minimum regulatory obligations, it appoints trustee directors to ensure that the minimum regulatory obligations happen. I mean, let me think, I don't know, something like making sure an AGM or anti-money laundering, maybe, would it be something like that? Okay, so they just make sure that the company meets its regulatory obligations.
These are the 2.
These are the, okay?
Right.
So that's sort of in this hand,
yeah.
Okay? Then you go to the other side and basically say the note holders are the investors in that, they're up there, sort of thing. They invest into the vehicle, right?
My question is, are they investing directly into
They invest into Glenbeigh, yeah.
And what then is the trustee?
So the trustee is over here, making sure that the company, known as Glenbeigh...
He's just making sure that they're okay.
Making sure that it's okay, that it operates properly, yeah.
But that's different than the 2, isn't it right?
No, the nominee directors of the trustee are the 2 guys who are making sure that it meets its minimum obligations.
And then it's Glenbeigh then that can sell on the notes.
So Glenbeigh issues the note. So we've got the bit about the trustees over here. The Glenbeigh then issues the notes, and you have investors who we've spoken about or not spoken about.
That's the one where you had no comment on whether it was.
That's the ones where both of us are subject to a non-disclosure agreement. They take the bonds.
It's those organisations are the vulture funds. So they're an arm's length away from.
They're the investment funds, yes.
The vultures,
The investment funds. Yes.
Yeah, the vultures.
The investments.
Yeah. Right. So I got that. I think we've. Oh yeah, the meeting with the minister. Then I know it's again for information. You only have to consult.
That's correct.
So is that a meeting, or is it just look, Pascal, we're selling off 1.3, just to give you a nod? Or does it actually go into an in-depth conversation about it, or what?
So my relationship.
I want to be prepared in case I'm Minister for Finance sometime. I'll be prepared.
Yeah, and they also have special advisors, and I'm more than happy to be one for you. The Minister for Finance can determine what that consultation looks like. I have to consult him on a lot of things. In many cases, it's just a letter, and it gets returned. For more major transactions, the Minister has the right to call me in and to discuss it.
Okay.
As you would understand, for both Gloss and Glenbeigh, it's involved face-to-face conversations.
Okay, that's all right. That's okay. Just to go back to that written consent of the borrower again, and the central bank, and ask two questions. So the written consent of the borrower is really a code of practice. It's a voluntary code. You don't have to.
It is a voluntary code. That's correct.
Yeah. And are the codes that you operate under then, Mr. Ryan, separate from the regulation? Are they voluntary codes as well?
No, so I think that voluntary code of practice applies very much to a seller. It's probably less relevant to the buyer. The codes that we follow, particularly CCMA, is in statute and it's legal. So we're regulated by the central bank. They can enforce on us if we don't follow the code.
Yeah. Now, lastly then, you engage with the central bank, Mr. Masing, in relation to the sale of these. I think that's what you said earlier on, that you engage with the central bank in terms of this portfolio of loans.
So we're, as you know, we're a regulated entity. This is the first transaction of this type that's been conducted in Ireland. It was very important to the bank that we took it in the right steps to ensure that those who are major stakeholders for us understood what we were doing. It was good practice for us to share, and as I explained, shared with the minister, shared with the board, shared with the regulator.
But you're not obliged to do that, you're not?
Not in its
with the central bank upon, but
not in its strictest sense, no.
Yeah.
But
But you went and it was a new thing, so you discussed it with them.
I mean, it's a material transaction for customers. It's a material transaction for the bank. It's the right thing to do.
Do they raise anything, or is this just an exchange of views as well?
My conversations with the regulator, I'm afraid, again, are confidential.
No, I'm not asking you.
But
I'm
sorry.
not asking.
No, I'll
sorry,
answer the question. I'll answer. Were the conversations value added during the process?
Yeah.
Yes, they were.
So right, okay. I said I'd wind up.
Just one quick one, Mr. Masing. You're down at 10% at the moment. Can you explain to me? There is talk that this pressure comes. Is it from the ECB and the central bank? Have you been put under pressure to get rid of what they call non-performing loans? And if so, going by the figures I'm looking at, you were at 16% and that's 6,000. Are you looking at the 5,000 more so to bring it down to 5%? And who puts you under pressure to cut down?
You should be in absolutely no doubt that the bank is like other European banks. The SSM wants us to reduce the NPL ratio, so you shouldn't have any doubt about We have to contribute to the stability of the Irish banking system. This is not just PTSB. We need to ensure that we can withstand future economic shocks. In that regard, the phrase that our regulator has used is detailed and credible plans. And so, as we discussed at my previous visit, and I think I placed it on the record, there's been no specific instruction as how to do it, but there is a very clear view that we needed to have realistic and ambitious plans. Now, as I said before, in terms of how do you deliver a realistic and ambitious plan, hopefully I explained to the committee this afternoon, my first duty is to the taxpayer, to try and do that in a way that minimises any capital destruction, which I think we've done. But obviously there are other elements of that. It's not just the hard financial as the governing objective. There are also supplementary tests. And one of the supplementary tests is to do that in such a way that got the right customer outcomes. And in this particular case, for those customers who have treated NPLs, it is the board and the bank's view that this was the least worst alternative.
Okay.
What are you looking at your board and the bank? Are they looking at, if I look at the percentages, 5,000?
We have about, I answered the question of one of your colleagues earlier on. We have about $1.5 billion of NPLs left, which equates to less than 10%. We have to keep managing those down. The good news is there's a sizable portion that will cure automatically. And then for the rest, we need to look at different alternatives. And so I wouldn't rule anything in and I wouldn't rule anything out. And that was the answer I gave to your colleague earlier on.
Okay.
Thank you.
So we're now at the end of it. It won't surprise you, Mr. Masding, when I tell you that I'm no fan of the arrangements that you've entered into. I prefer if there was a greater political urgency put into creating some different arrangement to give people a better chance. I know that you're managing your bank and Mr. Ryan here is doing his business with Pepper, and I often consider that we're here to remind you of what customers are saying and to attempt to get better outcomes further. Now I know that during the 10 minutes that we broke for there that you were approached about some FOI, and that happens in here. You know, customers end up coming in here listening to what goes on, and generally it's for information. So I hope that you can, resolve some of the issues that you may have heard here today, some of the individual issues the gentleman approached you, and to say to you that the information that you put out today, while it might be difficult for all of you coming here, but it is a way of publicly answering the questions that people are asking us. I'd ask you to see it that way. Mr. Masding is he's a hardened tender at these committee meetings, so he knows. But it's not a personal thing. It is a real serious problem for families, and we have to follow it up. And that's why I asked you at the very beginning of the meeting about coming again at some stage. It's not to ambush you. It's just simply to get it out there what is really happening. And if some of what we're being told is not correct, you get the opportunity to correct the record, because people are anxious to get on with their lives. So I understand the angst on your side, but there's also a pressing issue on the side of your customers. So thanks very much for coming along today, and my thanks to your colleagues and the staff here who have been very patient, and the clerk and her staff, in that we have been sitting here from 2 o'clock. Probably won't see you, Mr. Masding, before Christmas. So I wish you all a happy Christmas, including your hand down there. He's good form these days. Thank you very much.
Thank you very much.
Meeting is now adjourned.